We are live now. Good afternoon, everyone.
Good afternoon, everyone.
Good afternoon, everyone.
So the participants are increasing by leaps and bounds, as normally it takes about 5 minutes time to add all the participants who are waiting on the net. So at this time, while these participants are getting connected, I thought that I would probably answer the various questions which was also handled today by Dr. M.S. Sahu in this morning webinar, which was organized by IBBI and IPAs. So the first question which even many participants are asking over emails is also the how this would be implemented, the date of 25th of March 2020, how this would operate. And there's another very important clause, and that is that no application can be filed. So whenever we say that no application can be filed, according to my experience and common sense, it would make a kind of process where the application would be filed in case there is any. The registrar will see and verify the date of default in case it is not disputed. Then the registrar will admit the applications. Otherwise, one question which was being asked by someone to Dr. Sahu was very, very important, that whether the default is pre 25th March 2020 or post 25th March 2020, that also has to be adjudicated by the adjudicating authority. So that's what it is, because in case the adjudicating authority doesn't want to take that load of adjudicating each and every case, then they would provide some power to registrar that the application would only be admitted once it is prima facie seen by the registrar that the default is undoubtedly prior to 25th of March 2020. So this is one practical part which I think that will be seen in the future. And the other part that we are seeing is that as far as this 1 lakh, the threshold limit which is increased to 1 crore, that also depends upon the judicial pronouncements, because as we have seen, Kolkata NCLT bench has already given an order saying that the threshold limit would be applicable as on the date of filing of application and not as on the date of order initiating CIRP. This is a legal issue because the threshold limit, when a member is passing, when the adjudicating authority is passing an order initiating CIRP for any company, whether the threshold limit would be applicable as on that date or as on the date of application. This is a legal issue. I have already given my views at various forums that to my understanding, the threshold limit should be applicable as on the date of passing the CIRP initiating order. So that's what I feel. However, there is the entire profession is divided, but this I definitely can register my view that according to me, it should be applicable as on the date of the order that is initiating CIRP. Then the section 66, I think Dr. Sahu has very defined very clearly that the clause that they have added in section 66, subclause 3 has been added that pertains to the twilight zone. So in that twilight zone, in case I think the intention is to exclude that twilight zone also for the purpose of protection of losses to the corporate debtor during that twilight zone and use of due diligence by the managerial persons. So that also was clarified by Dr. M. Sahu. So I think this is what we can expect under this, because like this clause was introduced, and what I understand is this section 66 application is only possible in case the CIRP is initiated or liquidation is initiated. Without that, section 66 may not be applicable. So the subclause 3 of section 66, how that would be applicable and how it would be impactful when the CIRP is not initiating for any default, which is post 25th of March 2020. So how that would be relevant is still a question that of course would be settled gradually with the judicial pronouncements. So these two amendments, as I would say, the last time also I said that there are more than 8 lakh crores of NPA, which is still pending with the banks. Maybe a lot of them pertains to the partnership firms, proprietorship firms, individuals, where the insolvency and bankruptcy law is not applicable. But still, there would be many where the insolvency law is applicable. And that kind of business is still available in the market. And most of the banks, they would probably prefer to go for insolvency as there is no other feasible alternative available with the banks to handle the stressed assets. So the business in the market, then I think we should all try to popularize this individual bankruptcy, which is very, very useful for the personal grunters. They can have a fresh life, fresh start of life. They can get discharged from all their obligations, liabilities, and they can restart their businesses. They can restart having properties in their own name. Otherwise, their commercial life is completely dead in case they have given guarantee. And a lot of cases are against those personal grunters, maybe before DRT or maybe before any other court. So that also can be handled by those personal grunters by just invoking their personal bankruptcy. So after about 1 year time, they would get complete discharge. And that discharge would be very, very helpful for them to start their life afresh. Whatever experience they have got in the last, in the past life, that can be reused. Otherwise, that is not being used presently. So what I'm trying to say, that the business in the coming 1 year, till the time this suspension of IBCs for new cases and also from 1 lakh to 1 crore would be lesser. However, there would be other opportunities which might even come, and maybe this personal guarantor is an opportunity, and also the various restructuring and rehabilitation proposals that the professionals can make. So this, with this, we can start our main subject today, which is the part 2 of the liquidation process. To give you the little recap of what was in the past, in the part 1. Before I do that, I would like to introduce the co-panelist today. CA Anil Agarwal is a senior partner of AAA Insolvency Professionals LLP, and he is heading the Kolkata office of the IPE. CA Ankit Goel is also a partner of AAA Insolvency Professionals LLP. He is a valuer, and he is also a founder of AAA Valuation Professionals LLP, which is a registered valuer entity with IBBI for all class of assets. So these both panelists would help me and also share their experiences when it comes to valuation, how the valuation is disturbing the liquidation process. Ankit Goel will take some time in sharing his experiences when it comes to the practical experiences doing liquidation cases, because Mr. Anil Agarwal, who is a Kolkata-based senior partner, he has also handled many cases and also supervised many cases which are Kolkata-based and handled by partners. We have 7 partners in Kolkata, and he is the senior most amongst all the 7 partners. So he is handling various cases in his own name, and also he is supervising the cases in the name of the other partners. So with this, I will see, we also would take up some of the questions which are received by us over emails, and I would only request you that please post your questions on the Q&A section and not on the chat box, because we would be taking the questions from Q&A segment. And the Q&A is the at bottom of your screen, you would find Q&A section, question and answer session, and you can post your questions. And CA Anil Agarwal and CA Ankit Goel will take up the questions. Every 30 minutes, we would have a break, and we'll have questions at every 30 minutes. So I would share my screen now. So I believe it is visible to all. Is it visible? The co-panelists.
The first screen is visible, and maybe
Yeah.
you can try moving your
So
slide.
yeah,
Yeah, it
we
is
have
perfectly good.
started moving. So I started from the first because I would like to give you the recap in the first 5 minutes. And we said that how the liquidation orders can be passed under what circumstances, and then we also talked about the recent amendment, which is dated 16th of August 2019, that the liquidation order can be passed at any time, even before the preparation of information memorandum. That means that after the committee is constituted, after the COC is constituted, the liquidation order can always be passed. However, as Dr. Sahu today said in the morning, that the liquidation is the last resort. Liquidation is the death. And he very categorically said that in case we decide about the liquidation of a company incorrectly, then there is no reversal. However, in case we decide to keep the company as a going concern, hoping that this company would revive, and in case the company does not revive, and that the same liquidation order can be taken a year later, the next year it can be seen that yes, the liquidation order can be seen. So the liquidation, as everyone says, that the liquidation is the last resort. It is actually having an inferior economic value for all the stakeholders. That has to be kept in mind. However, there are various judgments. All this slide that we shared and the recording of the part one, detailed recording, which is for 2.5 hours, that is also available at our YouTube channel named as AAA Insolvency Professionals. So anyone who is missing any part or would like to get a detailed discussion on these subjects, which I am just taking as a recap, they can go and look at those recordings. So they will be able to connect part one and part two. So there are so many judgments where it has been held that the liquidation also can be the only option at times based on various facts of the case, like no operations, no employee, no business model, no business format, business activities are closed for so many years, there is no possibility of any resolution. So there's a lot of litigation. There's no reason to chase the litigation. So there are various the assets are dead, the company is not having any kind of alternative use, the product of the company is obsolete, it is having no demand, all these things. So immediately the effect of the liquidation was also discussed, the appointment of liquidator was also discussed. So this was also discussed now. This is very, very important that I should actually spend another 1 minute on this. The COC has power to appoint a liquidator. Gradually this is getting clarified. Although we started in 2018, June 2018, we obtained an order from Kolkata bench in the case of Keshav Sponge and Energy Private Limited, where we the COC appointed us as the liquidator, whereas the resolution professional was somebody else. So that was the first case that we tried, and we got this resolution passed from COC that they would like to appoint such and such person as the liquidator. So that was the first order in the name of Keshav Sponge, and even the later on, when this regulation 39D was inserted with effect from I think 25th of July 2019. It is very clearly said that the COC will decide the fee of the liquidator while passing the resolution for liquidating the company or for even approval of the resolution plan. So this is a very, very important amendment. Now what it means that in case the fee has to be decided by the committee of creditors. How can it be seen or said or believed that the COC has no power to change the liquidator? In case it is held anywhere that the COC has no power to appoint a liquidator other than the RP, then how come the COC has the power to negotiate the fee? Then the existing RP would always say that I will take this fee, otherwise I'm not going to work. So the COC would not have any power to appoint any other liquidator. The matter will go to IBBI. So that would be a complete disaster, and that will be a time-consuming part. So now the COC can put a bring competition amongst the prospective liquidators. The COC can definitely negotiate fees, and the COC can appoint. In case the existing RP, he is seen as efficient liquidator also along with the efficient RP, and he is also seen as a cost COSI. Then the COC would appoint him. Otherwise, the COC appoint any other person as the liquidator, because the COC will also see who are the people who are those people who can provide better services in the liquidation process. Looking into their infrastructure, looking into their experience, and looking into their past practice. And the past practice, the most important part would be the comfort to the stakeholders. Although we have also discussed like what are the powers of stakeholders consultation committee, those powers are not significant powers. And however, by practice, the stakeholders consultation committee is using a lot many powers. It is by practice and not by regulations or not by statute. So the stakeholders consultation committee will gradually become powerful, because whatever actions are being taken by the liquidator, in case it has to go through the stakeholders consultation committee meeting, that would be even considered as a shield for the liquidator, because there can be many situations where the liquidator can be attacked, or allegations can actually come to the liquidator for various actions taken by the liquidator. But if the liquidator go through the stakeholders consultation committee meeting, that actually will protect the liquidator also from any future action. So now all the RPs must be cautioned, and they must be prepared that in case the liquidation of the company would be considered, then the COC would appoint liquidator, would negotiate the fee, and they will choose their liquidator who they feel is better. So this is something which is very, very important powers, which by practice has gone to stakeholders again, like RP. In a recent case, I cannot name, see right from the beginning, it is the 8th month. It is the 8th month of the CIRP, and even no expenditure, no reimbursement of the expenditure, and no fee has been disbursed to the RP. When RP insisted for the fee in the 8th month of the CIRP, and it is a sole banker, and that sole banker said that we would like to change the RP. Without, see, like RP is working for 8 months, and the COC is not even reimbursing the expenditure that he is incurred, not even for the valuers, not even for the no expenditure, despite various reminders, despite approvals also. RP fees is approved, valuers fees is approved, every professional fee is approved, lawyers fee is approved, but the money is not coming from the bank. And when the RP insisted in the 8th month, the COC has actually taken the stand and changed the RP, and the NCLT has also passed that order. So this scenario would definitely be seen. However, some kind of good orders are required from NCLT, so that this should not be repeated. And it was only because the liquidators, the RP started asking for his money and started insisting for that. And this was a single COC member case. So this is all. There is another case. I think that's one scenario that the COC has no power to remove the liquidator. In case the COC has to remove the liquidator, the COC has to go through the IBBI, and the COC will file a complaint to IBBI, and IBBI will investigate into the complaint. And in case the IBBI finds that yes, there is a reason, and the liquidator is not performing to its best ability, and also there are some ethics issues, then the IBBI recommend to change the liquidator in any case. that also should be known. It's very important. So powers of the liquidator we discussed at length, and anyone who actually is not attending the part one, they can go and do that. Now the only one amendment that I still would like to take as for the financial creditors, for any other creditors, there is an option now during liquidation they can file an updated claim, or simply they can write a letter to the liquidator that the claim that I filed during CIRP, that should be taken as my claim during liquidation, and at the most they can only update it for the interest part of it. The claims were discussed, powers of the liquidator, submissions of the claim, verification of the claim was discussed. I think the one differentiation that I said, that all the financial creditors has to submit their claims by electronic means, whereas others like operational creditors, workmen and statutory, all they have the three options: by in person, by post, and by electronics means. So this was all discussed, and it was also verification of the claim was also discussed, based on the security interest was also discussed, the contingent claims, that in foreign, everything was discussed in the part one. And the verification of security interest, proving security interest, the presumption, section 52 and also regulation 21A was discussed, and even it was updated till January 6, 2020, when it was also now inserted in the regulations 21A, that in case there is any asset which is taken away by any secured financial creditor, that secured financial creditor will sell it within 180 days. Otherwise, it will be considered as sold, and the estimated value and the difference in the debt that would be paid by the secured financial creditor to the liquidator. So nowadays there is no case that the financial creditor, the secured financial creditor, will not relinquish the security interest in favor of the liquidation estate. There is no case now, because the secured financial creditor will have to pay the CIRP cost and the liquidation cost. The secured financial creditor will have to pay workmen dues for at least for 24 months as a pro rata allocation to them. So then they will spend under SURFACE or any other way that they sell the property. So they would be incurring double cost. And in case they are not able to sell, then they might have to pay the balance amount to the liquidator within 180 days. So all these regulations which are regularly coming, and the CIRP, the liquidation regulations are getting updated, it only shows that the intention of the government is that this liquidator should do the job, and the liquidator should complete the process, and the financial creditors should not sell the assets themselves. So I got a mail today. So one person was discussing his case, and it was Mr. VB Raju, and he asked me a question that it's a liquidation case. There is only one creditor, one secured creditor, and only there is one asset. Now that one secured creditor has already entered into an OTS with the promoters, and OTS with the promoters during liquidation, and has settled the dues during liquidation, and has taken the money directly from the promoters in the account of the bank, and they are ignoring the liquidator, and they are not even paying the liquidator's fee. Now there are a lot many non-compliances that I could see in this. Number one, that first of all, before the bank can go ahead and invoke section 52, the bank has to take a permission from the liquidator for handing over the assets back to the bank for sale at their level, and that would happen only in case the bank shares the CIRP cost and liquidation cost and the workman dues with the liquidator. Then only the bank can do that. Second part, even in case the section 52 is invoked and the bank is doing that, bank has got no authority to sell the same asset to the same promoters. So this is a second non-compliance. So I definitely would advise that this is a good case, and it would actually be a very, very big issue, that how the bank can do this, how the bank can take the entire law in their hand, and how the bank can sell the asset to the same promoter during liquidation after invoking section 52. And there is an amendment in the act which actually says that even after invoking section 52, the bank will not be able to sell the asset to the same promoter or any other person who is not eligible under section 29A of the IBC. So that's something which is, there's a lot of very non-compliances has been done by the bank, and I think it's an appropriate case to file an application to the adjudicating authority for justice. So this also is, a lot of questions are coming, like how would you create a balance between the first charge and second charge and subservient charge? I would again say that in the part one, I discussed this issue at length, and the report of the Insolvency Law Committee dated 26th of March 2018 was discussed. I also say to each and every person that you must read paragraph number 21.1 to paragraph number 21.6, which deals with this subject, which is the word shall rank equally between and amongst the secured creditors. So how that has been interpreted, how the Supreme Court judgment in the case of ICICI Bank versus Sidco Leathers Limited has been used, and how the section 48 of the Transfer Properties Act has been used while interpreting this particular way of having the rights and the rights of the first charge holder and the second charge holder. So this is also it was very clearly recommended by the Insolvency Law Committee in their report that in case I will just take an example here. So in case I'll just take three cases. One is that there is an outstanding of 100 crore against the working capital loans, and the current assets which are realizable as per the liquidation value, it is only 2 crores. Second part of the debt creditors are 50 crores is the outstanding, and they are the term lenders, and the fixed asset which are charged to them as first charge, those are having 20 crores as the liquidation value. And then the third is the another separate loan against property, where the loan is 10 crores and the value of the property is 20 crores, and that has been done by any other bank. And the other could be a car loan, where the car loan is where the car loan outstanding is 10 lakhs and then the value of car is 8 lakhs. So in such scenario, how would you handle? In case I total it up, the total value of the liquidation value is 50 crores, and the total debt in this case is 170 crores. So in most of the liquidators are thinking as if they have to allocate this 50 crores in proportion to the debt, which is 100, 50, 10, 10 to all the secured creditors. No, I would 100% say that this is not the correct way of distribution in a liquidation process. See, like what is the security value of term lenders? The term lenders are having a security value of 20. So they should get minimum 20 in case the assets are sold at 20, or in case the assets are sold at 25, then they should get 25. Similarly, on the other hand, there is a loan against property, and then the loan outstanding is 10 crore and the property value is 20 crores. So whenever the property is sold, they should get 100%. So in this case, the person is getting 100% because his value of security is more than the total outstanding debt. And the third case is where the total loan is 10 lakhs of rupees and the total value of the car is 8 lakhs of rupees. So in this case, if the car is sold for 7 lakhs of rupees, this 7 lakhs of rupees will be paid against this loan of 10 lakhs of rupees. So in case there are other assets other than the secured assets, then those assets would be sold and those assets would be distributed amongst all these creditors in their balance, which is an unsecured portion. So now the classification is that first of all, you actually have to see how much is the secured portion, and that secured portion is equivalent to the value of security interest. And then you calculate the unsecured portion. And then all the unsecured portions, which is for the time being in the first row of the secured creditors, that would be separately dealt with, and the secured portion of the loan would be separately dealt with. So this is the we have been doing it for since beginning, because presently we are handling 35 liquidation cases, and it is very pleasing always to share with you that based on our infrastructure, based on our transparency, based on our efficiency in finding a customer, the banks have decided to give us all the fraud cases to us. Like Nirav Modi companies have been given to us, like this Merul Choksi companies and the Gitanjali Jam group has been given to us for liquidation, whereas we were not the resolution professional in this case. None of our partner was the resolution professional in this case, but this case has been given to AAA only because of the the infrastructure for liquidation that we have built, along with our surface infrastructure, which is actually very they see a kind of helping our liquidation process also. So the surface infrastructure is complementing our IBC infrastructure, and IBC infrastructure is complementing our surface infrastructure. So this way, this Vikram Kothari is the Kanpur-based Rotomech group is entirely with us. The Junjunwala, which is REI Agro, and Varsana Ispat, that is also with us. And then there are other like HBN Dairy, which is a some kind of fraudulent investor scheme, where we have 3 lakh creditors, 3 lakh members of committee of creditors, and that is also called unauthorized investment scheme. And the SEBI has attached all the assets, and the criminal actions have been started against them. And then there are many other cases where the state government, like the Economic Offence Wing or any other state government, has attached the assets against any of the criminal law. So all these assets taken together, we have a great experience in handling those kind of cases where the assets are attached by any kind of authority. So the allocation has been discussed, as also we have to see the amendment in section 30 subsection 4 in IBC, which now clearly talks about including the priority and value of the security interest of a secured creditor. Including the priority and the value of the security interest of a secured creditor. That's what even during a resolution plan, the resources available under a resolution plan has to be allocated considering the priority and the value of security interest of a secured creditor. So there is no doubt about this. List of stakeholders and the stakeholders consultation committee was discussed at length. I just would like to reiterate here that this stakeholders consultation committee, in short, we will say SCC. The SCC has the powers to advise the liquidator on the matters relating to sale under Regulation 32. And in case we see this, what is that Regulation 32, then only we can see the left side of this slide, where the COC has to decide, or SCC has to decide, whether the asset of the company is to be sold as standalone, slump sale, collectively, in parcels, or as a going concern, or as a company as a going concern. Means business as a going concern, or company as a going concern. So this is the only power of SCC, which is the Regulation 32. When we even look at the Regulation 33, which is Schedule 1, which Schedule 1 decides about the mode of sale, whether it has to be sold as the e-auction or private treaty, the strategy for the marketing, the reserve price, how the time to be given, as is various basis. All these provisions are in Regulation 33, not in 32. So 32 is restricted to deciding whether the company has to be sold in what manner, assets has to be sold in what manner. So this is also for the clarification that the SCC as such is not powerful by law, but SCC is powerful by practice. Most of the liquidators, they have to work in the market. They have to build their reputation by way of transparency, by way of efficiency, and by way of results. So in case a liquidator is not able to give results to the committee or SCC, so that matter will spread around, and that person would not get fresh cases. So this basically is the liquidator has to live in the market. The market is very small. So in case the SCC is saying something to do, the liquidator mostly would be able to do that. In our today's subject, I would actually explain to you, and I will share with you how we are sharing everything with our SCC, and how we are trying to build a trust between SCC and the liquidator, and how they favor us in the liquidation assignments. The liquidation cost was also discussed at length. This is not to be repeated. And now I think we had reached at liquidation estate. So this is the real part 2 of liquidation process webinar, and so far I have given the recap on the earlier part 1, and some of the important topics that was there, I discussed that. So Ankit, is there anything that we can talk about now? Because
There
we
are
already,
there are a lot of questions, and I think what I can do is I can talk about these questions. I can mention them, and if you feel that these questions will be addressed in the PPT to come,
yeah,
then we can ignore them and we can take them up later. Else we can try and answer them.
yeah.
So basically, one question is from Mr. Chiragan, that as per IBC, buyer of plant and machinery of corporate debtor under liquidation has no liabilities transferred to it. Then why do RPs in the liquidation notice put a clause stating that all past, future, hidden liabilities of corporate debtors are to be borne by the buyer? In reality, this only reduces the price paid by the buyer.
No, this is incorrect. And during the liquidation, rather what we are doing is that we are only saying that as far as the local maintenance charges, maybe from any kind of local authority, maybe the society under which that property is, or maybe the Gram Panchayat. So those are the people which are actually very difficult to handle. Otherwise, as far as the electricity department is concerned, municipal corporation is concerned, we are giving notices to everyone that in case you have any claim, you can send it to the liquidator. And we are trying to sell the property which is free from all encumbrances, charges, lien, and kind of so any liability on that. So in case we do this, then the one that we would not have as many options of the customers available in the market, because the most of the customers would not be interested in litigation, they would be interested in certainty. And the customer has to be developed, the customer has to be given comfort. So in case we are not able to give comfort to the customer, then definitely we would only get one or two. So in one of our case in Central Color, we actually could generate 125 bidders and everyone deposited 50 lakhs of rupees to us. And then that particular property, in fact, where the value as per the liquidation value was only 17 crores, it went up to 42 crores. That was the example that we have set in the IBC liquidation process. So that's wrong, Ankit. That should not be done. Rather, the property should be sold as clear from encumbrances as possible, and all other claims should be taken by the liquidator and should be settled by the liquidator.
Okay. Then there is an anonymous attendee asking that what is the difference between acquiring the corporate debtor as a going concern under resolution process versus under liquidation process? I think this is a very interesting question.
Yeah, very, very interesting question, but that actually will come in my slides.
Then the process of scrap sale or the assets that cannot be sold, the process of disposal of such assets and disclosure requirement for the same.
That also will come in my slides.
There's a question on how a liquidator to determine the fees payable to the valuers appointed by him.
I think this we discussed yesterday in our part 2 of the valuation under IBC, and we can just briefly reiterate. Otherwise,
an interesting question: that is there any possibility of changing the registered office address of the CD during liquidation?
No, I don't think registered office has got anything to do with this, because the registered office change is not really significant, but most of the activities will happen in the name of the liquidator. So I don't see any reason for changing the registered office. In case the querist can give me the objective, I can give him the better solution.
Maybe we'll ask the querist to rephrase the question and then put it up again. Is it mandatory to comply with the 2B of IBBI regulation, IBBI liquidation regulations, when we can directly e-auction for liquidation cases?
No, regulation 2B is not saying anything about this, because there's nothing you can. The regulation 2B is all a decision of. Let me understand what is regulation 2 in case they have to indicate a little bit.
2B of IBBI liquidation regulations.
2B talks about compromise or arrangement. No, compromise arrangement is only in case there is any scheme of compromise or arrangement which is received by the liquidator. So there are some orders that we have seen by the adjudicating authority, where the adjudicating authority has directed the liquidator that you actually have to make some efforts to obtain the schemes of compromise and schemes of compromise or arrangement under section 230 of the Companies Act. In those cases, yes, we have seen, and we have also done, in some cases, we have actually given a public notice that we are looking for some schemes of compromise or arrangement under Section 230 of the Companies Act. Otherwise, it is not necessary unless liquidator receives a scheme from a creditor or from a member shareholder, then only the liquidator has to take the appropriate steps as required under Section 230 of the Companies Act. So 2B is not necessary in all cases unless it is specifically directed by the adjudicating authority.
I think we can proceed, and maybe we can take up more questions after some time.
Okay, let's start this part 2 formally, and the recap was also a little longer because I wanted to discuss the key issues which are coming to me again and again on various webinars or seminars that I do, or even on emails. The liquidation estate is the subject where we start today as part 2 of the liquidation process under IBC. The liquidation estate is defined under Section 36 of IBC, and which is all the assets of the company collectively are called liquidation estate. So there are inclusions and there are exclusions as defined under Section 36 of IBC. So let us first of all take some of the inclusions, and in case of anything which is a little confusing, I will also take up some of the examples. All assets over which the corporate debtor has ownership rights, as evidenced in the balance sheet or as per the records of the information utility or the records of the registry, any depository recording securities of the corporate debtor, shares held in any subsidiary of the CD by any other means as may be specified by the board. Now, in case you understand this language, the language is very clear that it is not important that the asset should be appearing in the balance sheet. Even if the assets are not appearing in the balance sheet, however, the ownership of the asset is proved that it belongs to the corporate debtor. That in fact we have seen in one of the cases like Rotomec Global, that our guard who was there at the site, our guard in fact received a letter from a builder, and that was a notice for demanding further money. And then we came to know that the company has invested in some plots, and there was no entry in the books of account. We couldn't see that entry in the books of account, and then we started chasing that asset. Similarly, we have been able to find many other assets which are not in the books of account or which are not in the balance sheet, and we have seen that the promoters normally do this kind of manipulation, and these manipulations has to be cracked. So we can see the information from because when we see the powers of the liquidator, it is a very specific power given to the liquidator, that the liquidator can even write letter to Cersei, to the registrar of documents, to the information utility, and to the depositories for the shares, and to any other like the income tax department also. So the liquidator can write and seek information from them, although these departments are not being are not ready to provide such information, but it has the liquidator has the power. Assets that may or may not be in the possession of the corporate debtor. So the now one question here is that any asset which is not in the possession of the company, that also will become part of the liquidation estate. So the one example is that the asset has been given on rent, and the rent deed, the lease deed has been executed, or rent deed has been executed. So in such manner, I haven't seen any adjudicating authority passing an order saying that the tenancy has to be terminated on the liquidation order. If it is a genuine tenancy, it cannot be terminated only because of the liquidation order. And if the tenant has further lease, which is a valid lease life, then this the lease would be honored, and the asset would be sold along with the lessee's rights. So that scenario that is almost clear. However, the intention behind the lease has to be seen. The relationship between the company and the lessee has to be seen. The intention, the relationship, genuineness of the documents, circumstances, All this has to be settled by the adjudicating authority, whether the tenancy is legal or tenancy is created. So this particular subject has been handled in detail under SURFACE, and even the Supreme Court and even the High Courts have held that the tenants are protected in case the tenancy is genuine. So I'll just give you an example. Like there may be many buildings in Kolkata, Mumbai, and Delhi, which are very old buildings and are occupied by the tenants, very small tenants, and the building is located very nicely. And in case it is vacated by the tenants, the building will have a value which is like multiple times of the present value. So this can be used, this tool can be used by any owner of the property, that the company should go to liquidation, and finally the asset value can be unlocked. Whereas the tenancy has been protected if it is a genuine tenancy. So nobody can say that I have a building in Kolkata which is occupied by 200 tenants, and filing a liquidation, and finally the 200 tenants would be evicted by the adjudicating authority and the property would be ready to be sold by the liquidator. So that is not the scenario. Next is the assets may or may not be encumbered. So encumbered or not encumbered, all the asset has to come to the liquidation estate. As I was taking an example during the recap session, that if only one creditor, liquidator, the one creditor has not given the custody and control of that asset to the liquidator and have sold that asset or have entered into an OTS with the promoter, that's it, that is completely non-compliant. The liquidator has to take control and custody of all the assets, whether encumbered or not. And then the liquidator will take the claims from everyone, and along with the security interest, along with the details of the encumbrances. So then the liquidator will decide the sale of the assets separately and settlement of the claims separately. All tangible assets, whether movable or immovable, is very clear. Intangible assets. Now the intangible assets that we talk, intellectual property, securities, including shares held in a subsidiary companies, financial instruments, insurance policies, contractual rights. Now the contractual rights is very important part of the liquidation estate. When I talk about a company where the most of the land is leasehold land, then I would not say that the company owns this land. I would only say that the company has a contractual right, which is a leasehold right on that land, and which may be a 99-year lease, and still there may be 80 years or balance of the lease life is 80 years or even lesser. That particular asset would be called as a contractual right, and that particular asset would not be called as land which is owned by the company. Similarly, the company may have entered into a contract, maybe a contract for developing a land and sharing the revenues. So that contractual right also would have a value. In the real estate cases that we have seen, that the company has entered into a development rights with some landowners, and those landowners have handed over the possession to the company for development of the site, and the company goes into the liquidation or during CIRP. So the very important part that we have to see is what is the value of that contractual rights. So in case we have to assume that the contract would be fulfilled or not. Once the assumption is clarified, whether it is whether the contract can be executed or not, so then the valuation of that contractual right has to be seen. So this is a very important part that we have to discuss with the valuers, because the valuers would not get any information about the contractual rights. And there may be many contractual rights. There may be some kind of arbitration pending. There may be some kind of claims. There may be some kind of advances that we have given, and then some refunds are due. All this is basically a contractual rights or the legal rights. So these are all part of the liquidation estate and must be valued very carefully. Now the other part is the assets which are part of the liquidation estate, assets subject to the determination of ownership by the court or authority. So this belongs to the disputed assets, where the ownership is even disputed. The status quo to be maintained in such cases, it will be considered as a liquidation estate, as I clarified in part 1, that during liquidation process, all the litigations would resume, which were kept in abeyance during CIRP would resume wherever. However, during CIRP also, in case there is any likelihood of asset getting developed out of a litigation, then the RP is supposed to continue with that litigation, and those litigations would not be kept in abeyance, because those are not pertaining to the liability, those are pertaining to the assets. For example, any refund or insurance claim, the RP is not supposed to say that it is the RP is not supposed to say that it is a moratorium, and in the moratorium all the litigation would stay. Not regarding the assets. RP is supposed to pursue that litigation, get that asset crystallized, take that asset, and enhance the value of the corporate debtor. Any asset or their value recovered through proceedings for avoidance of transactions in accordance with section 43, 45, 50 or 666. So yes, anything recovered would fall under liquidation estate from any proceedings under section 43, 50, 55, 43, 45, 50, 66. That means the preferential transactions, undervalued transactions, extortionate transactions, and fraudulent transactions. So all these transactions, in case any amount is recovered, that also will fall as the liquidation estate. Any asset of the CD in respect of which a secured creditor has relinquished security interest. Of course, we've already seen that. Any other property belonging to or vested in the CD at the insolvency commencement date. This is another definition of saying assets. All proceeds of liquidation as and when they are realized. Now, the proceeds of the liquidation as and when they are realized, like the money may be realizable from sundry debtors, advances, claims, arbitration, everything will fall part of the liquidation estate. All recoveries done from receivables, claims, advances during liquidation, that's all part of this. Now, specifically, these are the assets which are not part of the liquidation estate. So the first one is assets owned by a third party, but are in possession of the CD, including assets held in trust for any third party or the bailment contracts. So this is a very interesting clause, and that the assets owned by a third party are not part of the liquidation estate. However, the contractual rights definitely would be a liquidation estate. So in case there is a land which is available to the CD on a contract of lease, say for 15 years, 20 years, or 99 years, that particular land is not a part of the liquidation estate, but the contractual rights is the part of the liquidation estate. The contractual rights is the part of the liquidation estate. So the contractual right cannot be excluded by just saying that the property belongs to third party. That means that any property which has been allocated by any industrial development authority or industrial development corporations of all these states, which are all leasehold, that actually would not fall as an asset. So any leasehold property would not fall as would not be considered as a liquidation estate, but all this would be considered as a contractual right. Any asset held in trust for any third party bailment contracts is definitely something which we can always say that any asset which is only held as a trust, that would not be considered as the as a trustee or bailment contracts. Now, the very important and disputed question which is coming, all sums due to any workman or employee from the provident fund, pension fund, and the gratuity fund. Now, we actually have to see this word carefully: the provident fund, the pension fund, and the gratuity fund. I will just take a minute and I will come to the next slide to discuss this part, and that is the reason that I have just highlighted it in red alphabets. Other contractual arrangements which do not stipulate transfer of title but only use of the asset. So these are those kind of assets where something I have taken on lease, something I have taken for use, and while the asset doesn't belong to the company, but any contractual rights, then in case there is any value for that contractual rights, that is a very, very important part of my liquidation estate. So we should not confuse between this clause 1 and the clause 5, because these two are very, very clearly saying that the asset doesn't belong to us, but the contractual right that actually very clearly was a part of the liquidation estate. In case it has a value, in case it is sellable, then that contractual rights will actually be a very big part of the liquidation estate. Such other assets as may be notified by the central government in consultation with the financial sector regulators. We haven't seen any such notification under this clause. asset in collateral security held by the financial service providers and are subject to netting and set off in multilateral trading or clearing transactions. So these are the margin money that we have always seen, that the margin money kept by the financial service providers, those are supposed to be net off while filing the claims. So any broker or any financial service providers assets in security collateral held by the financial service provider and are subject to netting and setting of multilateral trading or clearing transactions. So in this case, when we talk about financial service providers, that includes banks also. And when we also talk about this security collateral, that is also that also refers to the margin money, and that can be in the shape of an FDR or that can be in the shape of a cash margin. So when this bank is issuing any bank guarantee or a letter of credit, the bank will take a security collateral of any asset, which may be an FDR in the bank or a current account or a cash margin. That can be net off by the bank when they submit their claim. So that would not be the part of the liquidation estate. So the liquidator would not be able to say that this particular FDR, which is a collateral security for the bank guarantee or letter of credit, that FDR should be given to the liquidator and the claim should be filed for the bank guarantee or the letter of credit. Two words has to be seen very, very clearly. Financial service providers is already defined, and this includes banks also. Security collateral is a security which is again given to provide some facilities. So if the facilities are bank guarantee, letter of credit, or anything which is having a direct collateral security of cash margin or FDRs, that can be net off. That can be net off, and that netting off is possible. So the liquidator has no right to say that you give me the FDR, then file the claim for the bank guarantees and the letter of credit. Next, personal assets of any of the shareholders or partners of the CD, provided such assets are not held on account of avoidance of transaction that may be avoided under section 43, 45, 50 or 66. So the personal assets are not part of the liquidation estate unless it is held by the adjudicating authority, that these personal assets would be attached only to recover money which has been adjudicated by the adjudicating authority under these four sections. Assets of any Indian or foreign subsidiary of the corporate debtor. So yes, the subsidiary company's assets are not part of the liquidation estate. Any other asset that may be specified by the board, including asset which could be subject to set off on account of mutual dealings between the corporate debtor and the creditor. There is nothing so far which has been specified in the regulations also, but yes, these two clauses are very clearly saying that if company A has got two accounts, one account is the credit and one account is debit, so when that company will submit the claim, so they would net off that and they would adjust the asset as against the liability. No, so we put this red text into pause regarding the provident fund, pension fund, and gratuity fund. Happily, I have to share with you that there is a recent judgment dated 11th February 2020 in the name of Saman Godiwala, who is the liquidator of Lanco Infratech Limited versus Apala Shiva Kumar. Now, the facts of this case is that the workers are saying that we should get this, we should get our pension, gratuity, and provident fund in full outside the liquidation estate, and the balance, all other dues can be considered as workman dues, which would stand pari passu with the secured creditors. And they were taking the example of State Bank of India versus Moser Bear Karamchari Union case, and which was dated March 2019. And it was all based on this particular line, which I'm again highlighting: the any sum due to any workman or employee from the provident fund, pension fund, and gratuity fund. Now, in this particular judgment, ANCLAT has differentiated between the gratuity payable, provident fund payable, and superannuation payable from the gratuity fund, provident fund, and the superannuation fund available in the company. See, any sum due to any workman from the fund, because the wording is the from the fund. That actually means that if the fund is maintained by the company and the company is taking the contributions from employee and employer, and then it is being invested in securities, in that particular fund, if there is any amount that is not a part of the liquidation estate and that has to be paid to the workman over and above the section 53, even before the allocation of section 53 starts, even before the liquidation cost, even before the CIRP cost, even before the secured creditors. So that's what is the mandate, which was the State Bank of India versus Moser case. However, this particular judgment of Sawan Godiwala has completely reversed it. It is very clearly written in the, after considering even the judgment of Moser, it is very clearly written that the funds are different and the dues are different. Now we are talking about the dues, gratuity dues, and it was given in the examples in the order that in the case of Lanco Infratech Limited, there were about say 20 crores of gratuity dues, and it was also mentioned there in the balance sheet that the company has defaulted under Section 4 of the Payment of Gratuity Act. Even then, the ANCLAD said that this has got nothing to do with the gratuity fund or provident fund or the superannuation fund, because those funds are not available in this company's case. The company was not maintaining those funds, and there is all these claims of the workmen. These claims would actually be considered under Section 53 pari passu with the secured creditors. So this judgment has given a relief in many cases. We were also suffering in the case of Samtel Color, and now this also gets kind of clarified, and we will take this liquidation of Samtel Color forward, because otherwise the workmen of Samtel Color, they were asking for 7 years provident fund, and that was the equivalent to the entire liquidation value of the company. Distribution of waterfall mechanism, we are not going to spend any time. The only thing that we would like to say that we actually have to see very carefully, very carefully, that when we talk about workman dues, it is only talking about the workman dues only 24 months. See, these 24 months has to be seen, and when we talk about the employees, it talks about only for 12 months. And then we talk about the subclause E. Subclause E very clearly says amount due to the central government and the state government, including the amount to be received on account of Consolidated Fund of India and Consolidated Fund of the state, in respect of whole or any part of the period of 2 years preceding the liquidation commencement date. This is very important part that you have to see whenever we are trying to collate, verify the claims from central government, state government, local authorities, statutory authorities. Then we must see that claim must be for only for 2 years, whole or any part of the period of 2 years. So not more than 2 years, like in case because normally the assessments or the government dues are on a financial year, so that we can very well say that the 2 financial years preceding the liquidation commencement date, those would be considered under section E, under subclause E. And then the balance amount. Now let us see the subclause F. The workman dues beyond 24 months will come here. The wages beyond salaries of the employees beyond 12 months will come here. And the government dues, state government, central government dues for the period beyond 2 years will also come here. And then this also will be added by the market liabilities against the supply of goods and services. So this is some point that I wanted to highlight. And now we are coming to the various kinds of reports. So Ankit, I still feel before reports we should take some examples.
Take up some questions. Yeah, exactly. So one question with respect to the PF that you just discussed is from Mr. Ramila Rangasamy. He says dues deducted but not paid to EPF. Should this be considered as operational creditor?
So the any dues which are workman dues or employee dues, it has to be categorized as first workman dues and then employee dues. So if it is a workman due, it falls under this section the subclause B of section 53, which is having a pari passu distribution along with the secured creditors. So in case it is an employee's dues, then it actually will go to subclause C. So it is like the employees are also supposed to be bifurcated into two classes. One is workmen as per the Industrial Dispute Act and other is employees. So even if it is an employee contribution or it is an employer contribution, everything is workman dues. Similarly, the tax deducted at source and not deposited, that is also a workman due, because they have not got their TDS. That is also a workman due. So that also will be added as a workman due or an employee due as a salary. So we can't even say that the TDS has to be deducted over and above the liquidation estate. That is also not held by anyone, because that means that there are many things like the GST also is being collected on behalf of the department. TDS has to be collected on behalf of the department. Service tax also has to be collected on behalf of the department from the customers. Excise also has to be collected on behalf of the customers, on behalf of the government from the customers. So in case we start considering this rationale that it has been collected, it has been deducted, that doesn't mean that it actually is having a different meaning of a statutory dues as against the income tax. So all these statutory dues, maybe it's like excise duty collected or custom duty collected or even the service tax collected, GST collected, VAT collected, everything would actually have the one meaning, that the amount is due to the state government or central government or consolidated fund of India or consolidated fund of state or local authorities. So with this, all the statutory dues, especially the statutory dues, these provident fund and ESI are not statutory dues, because these are not due to central government, state government, or any local authority. These are workman dues and would be considered as workman dues. And as far as the PF is concerned, as far as ESI is concerned, that also would not be considered as a workman dues, because that never goes to workman, that goes to an organization which is providing services to workmen. So the ESI dues are not even workman dues. ESI dues are not even employees dues. ESI dues are operational dues which are payable to them as a service provider to workmen.
There is a question on whether leasehold land allotted by developmental authority to the CD for industrial use would form part of liquidation estate. I think yes.
I think I've answered that. I've answered multiple times. The leasehold land as such is not an asset owned by the company. However, the contractual right is one of the item of the liquidation estate, and the contractual right will have a value. Any contractual right which has a value, that is a part of the liquidation estate. So any leasehold land is a contractual right. Maybe the right is for 80 years or 70 years, and that right has a value, that has a market value, there is a premium. So that is a valuation which has to be done as a value, and that is an asset and is a liquidation estate part.
Then there's a question from Mr. Ananda Kurada. He says that a company is in liquidation, bank is insisting to honor invocation of performance guarantee presented by custom authorities. Is it justified, or does it amount to preferential transaction as per section 43, as it amounts to disturbance in waterfall preference as per section 53? So I think there's a performance guarantee.
During liquidation, one, that it is the liquidator's duty to protect the performance guarantees given by the corporate debtor. So in case the liquidator is unable to protect those guarantees, then the beneficiary customer will get the money from the beneficiary customer will get the money from the bank. So the beneficiary customer has already that benefit because the bank has already filed their claim of the outstanding bank guarantees or letter of credits. So that money will go from the bank to the beneficiary. So that would not impact the liquidation estate liquidation process, because the bank has already filed their claim for any outstanding bank guarantees or letter of credits. So bank in case has to pay that, it is the bank's loss, and the liquidator has got no right except the liquidator can try to prevent the invocation of the performance bank guarantee by performing the contract, by keeping the company as a going concern, by even complying with the default liability for which the bank guarantee was given. So the liquidator can make effort, because in various cases like the EPC companies, we as a liquidator, we are taking care of the default liability so that the performance bank guarantee is not uh, is not invoked. For even recovering the retention money with various customers, the company is being kept as a going concern, and some part of the warranty is being attended by the liquidator, so that the retention money can be taken back from the customer. So these are the obligations of the liquidator to enhance the value for the creditors. So in the case of EPC company, this is a bigger responsibility to keep the company as a going concern partially, keep some of the people or keep some of the contractors who actually would handle the default liability or warranties or some of the performance of the contract, to save the bigger money for the creditors. Yes, Ankit.
Next question, I think we can take up with Mr. Balasubramanian. He says that, sir, I am a liquidator of a CD and my fees fixed to be paid on a monthly basis by the COC in the last meeting, but the AA in their liquidation order has fixed my remuneration as a percentage. And basically he says that now he has asked the COC to approach the AA and get the order corrected, but this is, I think, he says,
No, see,
what is
like
my stand as a liquidator?
No, see, your stand, first of all, you might have to see whether the COC approved this fee before the liquidation application was filed. Second, you have to assure whether this particular resolution which was passed by the COC was submitted to the adjudicating authority. So in case these two things have not happened, then the adjudicating authority has done right thing, and the adjudicating authority has said that the regulation 4 of the liquidation process regulations would be applicable, and that is a percentage. So in case of any such scenario, I think another application has to be filed by the liquidator to the adjudicating authority, where the committee of creditors or the stakeholders will also part of the respondents, and they will also confirm that this is what was settled, and the order of the adjudicating authority can be modified.
Next, we have a question from Mr. Ramela Rangasamy. He says that valuation done during CARP period, liquidator proceeded to sell the assets with the same valuation, but unable to sell through reduced to an extent of 25%. So he says that even if we reduce the reserve price by 25%, he's still not able to sell. So can he appoint fresh valuers?
Yes, the liquidator can take a decision of appointing a fresh valuer anytime, because see, and this is also one of the issue in case the SCC doesn't have any power to stop the liquidator, but I suggest that the SCC should be taken into confidence, and the SCC should be explained why the valuation was not got done earlier, why you are thinking now to get the valuation done, the earlier valuation is incorrect, and into what extent it is incorrect, what are the gaps in the earlier valuation, what are those factors which was not considered by the earlier valuers. All this has to be presented before the SEC to finally get a consent. I'm not saying approval, to finally get a consent and informed decision. So one should take an informed decision to generate credibility as a liquidator.
Then we're talking about So there is a question that when the assets, Mr. Ganesh Baliga is asking that when the assets sold by the financial creditors, which is under mortgage, the consideration should come to liquidator's bank account and utilized as per waterfall.
Now the assets cannot be sold by the secured creditors during the liquidation process. So in case it has to be sold, that has to be done under section 52, where the liquidator will identify the asset. Liquidator will first of all take the claims, will approve the security interest, will identify the asset. Then the liquidator will see that the relinquishment of the asset has not been done in favor of the liquidator. Then the liquidator will ask them to contribute towards the CIRP cost if pending, or the liquidation cost. Then the liquidator will ask them to pay for the workmen dues, which is pari passu to the secured creditors. After all these formalities are done, then the liquidator will hand over the asset to them, and then that too the bank will have to sell within 180 days. In case the bank doesn't sell it in 180 days, or the bank doesn't comply with the payment of liquidation cost or CIRP, then the asset will be considered as relinquished in favor of the liquidator. So all this is very, very important. This actually regulation 21A. Please read regulation 21A of the liquidation process, and you would actually be very, very clear about it.
Then there is a question from Mr. Vinod Kumar Shah. He says that whether COC can fix the fee of liquidator as per the table given under Regulation 4, but limited to the amount realized and nothing on distribution.
The COC has the power to fix a fees. COC can tamper with the chart. COC can say that we will be paying only one part and not the second part. It is all up to the arrangement between the COC and the liquidator. The COC can even give monthly fee.
The chart
COC
is
can
only
also
recommended. The chart is only an alternative if nothing is decided. So anything else can be decided if I'm
anything.
not
The fee can be decided even on a success basis. Fee can be decided on various other methods also.
So a few queries there few queries have come in that this 90-day period to sell the concern as a going concern. So the questions are that can the sale under going concern be done
We are
after
coming.
90
We have a separate
days?
slide for this.
What
Ankit.
if 150 days
we have a separate slide for
that
this.
can be taken up? I think let's resume, and so I think we can take up more questions.
So I would like here, because since we have discussed so many parts, now it is coming to reports. I would like Mr. CA Anil Agarwal, who is the senior partner at Kolkata for AAA Insolvency Professionals, to share some of his practical experiences and the difficulties that he has been facing in multiple the liquidation assignments that he is handling. So Anilji, can you just share your experiences, because you also have got a lot of experience. So, and also Anilji, I'm very happy to see that there are 82 questions which are in Q&A section, and we are only able to take up, although we are trying to do it very quickly, but we are only able to take up these many questions. But Anilji, in case you can share your experiences, that really would be very, very enriching to our participants.
Yes. Good afternoon, everyone. The practical difficulty which I face during a liquidation assignment was not limited to the claim only, the adjudication of claim or the sale of assets. The liquidator faces problem at every stages. During the admission of claim, we need to verify the document. The document from the corporate debtor. We don't get document from the corporate debtor since and no employee is available once the liquidation order is passed. So no, the documents are in the custody of corporate debtor office. They do a lot of delay in handing over the document, and they don't cooperate once the liquidation order is passed. So this is the challenge which we face for the claim verification and part for admitting the claim of any of the stakeholder. Second, during for valuation, in most of the assignment, I see the valuation are incorrect. Valuation are not correctly done by the valuer. Since one of our asked the question that the valuation was very high and he was not able to sell even after the 25% reduction in the price. So this is a big challenge. After the IBBI regulate this profession, I think this problem will solve in very and standard will be developed also. Thirdly, I want to say liquidator faces problem in selling of the assets if the assets are attached by any of the government authority. In most of our cases, we see that the CBI, ED and the EOW attachment are done. We were not able to get those property attached earlier. But after the amendment of section 32A, now we are able to get it attached, and we are getting order from NCLT for detachment of all these assets. Even after getting the order from NCLT, we are facing a lot of difficulty from getting handover from the different department for all assets. In one of our cases in Calcutta, we got the attachment order from the NCLT, but we are making the department to kindly handle we not it last you can say last 3-4 months the NCLT order is passed. The most challenging factor is the marketing of the assets, sir. The marketing of the assets, since I'm the partner in Malay and we have a huge marketing team, we are able to market our assets. We have a separate marketing team consists of MBA and other qualified person who do a lot of research in getting a client, identifying the client, and giving the comfort to the client. That is more important than giving the comfort to the client, so that if he buy any asset in liquidation, he will not face any problem once he buy no litigation problem, because the what I feel the any investor.
Anilji, your voice is breaking. Maybe you might like to try with your video off. Maybe that will become better.
The video was off for the time being. I think he's already covered the one part of it, and the second part will start it after about 30-40 minutes again.
Yes, sir.
Yeah. So thank you, Anilji. Although we have many experiences, we have a separate slide for practical experiences, and then I will again ask you various examples, even with the names of the companies, that you can share with the participants. The liquidator assignment, let me resume now. The liquidator assignment is a very, very challenging assignment. One that it actually puts a lot of responsibility on the liquidator. The committee of creditor is not sitting on the head of the like RP. The SCC is not having any power. There is nothing like resolution that we have to pass, a resolution based on the voting share in the COC. Liquidator is supposed to maintain too many records and too many litigations that would restart after the liquidation process is started. So we have listed various reports which are supposed to be prepared by the liquidator. So the first would be to evaluate the assets and the properties of the company in the manner as will be specified. So that's what is the asset memorandum. Asset memorandum that we have to prepare within 75 days of LCD, liquidation commencement date. To report the progress of the liquidation process in a manner. So that's again section 35(1)(n), and it is supposed to be given every quarter, in 15th day from the close of the quarter. That is called progress report. So preliminary report is also like report prepared in accordance with. We will actually cover these reports in detail. And the progress report, first progress report, preliminary progress report, quarterly progress report, asset memorandum, subsequent progress reports, the sale report, minutes of the consultation with the stakeholders. All this has to be submitted to adjudicating authority, final report prior to distribution, and all the copies of the reports and minutes has to be provided to the stakeholders on an application from the stakeholders. So even the cost can be charged. So this is also very important that all these reports and the books of account and the registers which are required to be maintained by the liquidator, that has to be preserved by the liquidator for 8 years after the dissolution of the corporate debtor. That means if the company takes on an average 18 to 24 months from the liquidation commencement date to the dissolution, then it actually is required for 10 years, 2 years while we are making the documents month on month, and then for next 8 years. So all these documents has to be kept physically as well as electronically. So this is also a very big responsibility with the liquidator. Today, if somebody wants to be a liquidator, then he would always be, he would actually need to comply with the some law, at least for the next 8 years after this assignment is even over. Coming back to the preliminary report, although there is no format given, there is no form given, but then we have analyzed the sections and the regulations. So the information that is required to be given in preliminary report is promotions of the corporate debtor, formation, failure, conduct of the business of the CD, plan of action like the carrying out the liquidation, how the liquidation will be carried out, timeline for the liquidation, estimated liquidation cost. In the preliminary report, the capital structure, the estimates of the liabilities and assets of the liquidation on the LCD, all this has to be given in the preliminary report, which is to be submitted to an adjudicating authority. Then there is a possibility of early dissolution, and that particular possibility is mentioned in regulation 14, which says that after preparing the preliminary report, if it appears, because there are so many cases before the adjudicating authority where the early dissolution has been order has been passed. When it appears to the liquidator that the realizable properties of the corporate debtor are insufficient to cover the cost of the liquidation, the affairs of the corporate debtor do not require any further investigation, the liquidator may apply to adjudicating authority for early dissolution of the corporate debtor and necessary directions in respect of such dissolution. So this is an early dissolution in case you get an assignment where the assets are not there and there is no point that you should cling on to the assignment. So you should file an application for early dissolution, and that is under regulation 14 of the liquidation process regulations. The progress report is supposed to be filed for every quarter or part of the quarter, because the first report would be for a part of the quarter and subsequent reports would be for one full quarter. In these reports, we have to discuss about the appointment, tenure, and cessation of any professionals, a statement indicating progress in the liquidation, including the settlement of list of stakeholders, detail of any property that remains to be sold or realized, distribution made to the stakeholders, distribution of unsold property made to the stakeholders, details of the fee or remuneration, including the fee due to and received by the liquidator, description of activities carried out by him, remuneration or fee payable to professionals appointed by the liquidator, description of activities carried out by professional, other expenses incurred by the liquidator. So every report that we submit to the adjudicating authority, all this information is submitted to the adjudicating authority. Development in any litigation, that has to be separately mentioned, and the avoidable transaction status has to be mentioned separately in the progress report. Every progress report, we actually have to mention any changes in the estimated liquidation cost. Also, the receipt and payment that is being maintained, that has to be attached with the progress report. And once in a year, at the close of the financial year, we also supposed to file an audited receipt and payment account. So the progress report should also make a statement regarding any material change in the expected realization of any property, the basis of such change. The progress report for the fourth quarter should actually have an audited statement. So what we are now trying to discuss here is that the progress report is very, very important. And in the progress report, we are also supposed to submit all the minutes of the meetings of the stakeholders consultation committee, because that is also one of the report. And all the reports, whatever we have done, maybe for a sales report, sales certificate, all these, or the claim verification, everything that we have done, that should be reported as a progress report. Because in future, in case there is any litigation, whatever is everything that has been submitted to the adjudicating authority as a progress report would be considered as correct, because that was submitted to the adjudicating authority before any litigation, before any dispute started. So the progress report has to be very detailed, along with all the annexures. Mostly the progress report filing itself is considered to be a very large assignment in itself. And it takes a few days. In fact, it takes about a week's time in collating all these documents and information and preparing the progress report. There are some other reports which are mentioned in the regulations, like the asset memorandum we've already discussed, asset sale report we've already discussed. Regulation 33(3) also provides for the report of the colluding sales. So in case the liquidator feels that this e-auction has been, there is a cartel or there is a collusion between any section of the stakeholders or the buyers or the corporate debtor or the liquidator, so then that kind of report will be filed by the liquidator, and that particular transaction can be cancelled. That sale can be cancelled. E-auction can be cancelled, even if the e-auction was done at the reserve price. In case the liquidation is not completed within 1 year, then we actually have to file an application for extension, and the final report, of course, has to be submitted for the dissolution. In case the liquidation cost as estimated in the preliminary report is exceeded, then each and every item has to be estimated separately, and we have to explain to NCLT. So these are various registers that has to be maintained by the liquidator. First and foremost is the completion of the pending books of account, because unless we complete the books of account, we would not be able to get the information about the assets of the company. The liquidator shall maintain various registers and books as mentioned in the line 4 of the slide, shall preserve them for 8 years. Now, in case you see what all the registers that are supposed to be maintained by the liquidator, these are cash book, ledger, bank ledger, register of fixed assets and inventories, securities and investment register, register of book debts and outstanding debts, tenants ledger, suits register, decree register, register of claims and dividends, contributory ledgers, distribution ledger register, fee register, suspense register, document register, books register, register of unclaimed dividend, undistributed properties register, other books of accounts and registers as may be necessary to account for transactions entered into by him in relation to the corporate debtor. Formats for all these registers and the books have been provided in Schedule 3 to the liquidation process regulations. The liquidator shall keep receipts for all the payments made or expenses incurred by him. This is specifically mentioned. Now, these are the, let us consider too much of work for a liquidator to maintain, and since the liquidator is not supervised by a COC, it actually becomes a very, very big responsibility on the liquidator to maintain all these books of account for handling any claims in future, for handling any litigation in future. Asset memorandum, as is provided in Regulation 34 of Liquidation Process Regulations, this also has to provide this is to be made as on the date of liquidation date. This is basically we have to form a liquidation estate. The liquidation estate is formed under Section 36 of IBC. This is to be prepared within 75 days. The information which should be there in asset memorandum, that is value of each asset as per valuation report, intended manner of sale as provided under Regulation 2, whether it has to be assets, standalone assets, in parcels, lump sale, as a set of assets as sold in parcels, or business of the company as a going concern, or a company as a going concern. Then also we have to say the mode of sale. Mode of sale is so there are two things that we actually have to consider very carefully. Manner is provided in Regulation 32. Manner of sale is provided in Regulation 32, whereas the mode is provided in Regulation 33. So manner is where the SCC has the power to suggest, whereas in the mode, the SCC doesn't have any power. So the liquidator can, and according to the circumstances, can go for e-auction, physical auction, or private sale. Liquidator is not restriction. The liquidator has no restriction. The liquidator even can directly privately sell an item. However, the process has to be adopted. The process which is written in Schedule 1, that has to be adopted very carefully by the liquidator, even if he has to do a private sale. Expected amount of realization has to be mentioned in the asset memorandum and any other influence. Now, this asset memorandum is a very, very critical thing. And before we even prepare the asset memorandum, before we submit the asset memorandum to adjudicating authority, it is not even possible to sell any asset, because first of all, we have to declare it to the, unless it is the emergency. Yes, of course, in some emergency, we can sell the assets and we can report it to the adjudicating authority. However, in most of the cases, the assets are to be sold only after the assets memorandum is submitted to the adjudicating authority. The asset memorandum is such a thing which is provided in Regulation 34(5), that this particular asset memorandum shall not be accessible to any person during the liquidation, because this is a top secret document, and even it is SCC also would probably have no power to look at the asset memorandum. Regulation 32 that we have already decided, we have already discussed. Now we come to the valuation during the liquidation process, as provided in Regulation 35 of the CIRP, as well as the same way the Regulation 35 of the liquidation process. See, the liquidator has a liquidator to decide whether the valuation which was done under Regulation 35 of CIRP can be used or not. So my suggestions here are that you should look into the valuation in detail, look into the completeness of the valuation, look into the basis, the approach, the premise which has been taken by the liquidator for the purpose of valuation, and whether that matches with your understanding of the assets of the company or not. After looking into the report in detail, then the liquidator can take a decision whether the valuation is required or not. And that decision has to be taken immediately on the liquidation commencement date, because once the liquidator take a decision, within 7 days, liquidator has to appoint a valuer. Within 7 days, the liquidator has to appoint a valuer in case liquidator decides to appoint a fresh valuer and not to use the valuation done under regulation 35 of the CIRP regulation. Then in case the liquidator has to appoint a fresh valuer, then the valuer has to be appointed under regulation 35 of the liquidation process regulation. So both are regulation 35 of CIRP, regulation 35 of the liquidation process regulation. Then the regulation 35 of the liquidation process regulation says that the liquidator should inform the valuer that under what sub clause of regulation 32 the liquidator would like to valuation to be done. So the liquidator can tell the valuer that I want the valuation as a going concern, or I want some of the asset as a going concern and some of the asset as the business as a going concern, or any combination of various clauses from A to F of regulation 32 of liquidation process regulation. So that is something which is very, very important for all the liquidators to decide and convey to the valuer. Otherwise, the valuation would be incorrect and the liquidation process would be unnecessarily delayed and it would be more expensive. So the more and more liquidation e-auctions, and for a kind of illogical price as a reserve price would only eat away the cost, time, and also the frustrating the liquidation process. The trust on the liquidation process would be completely shattered, and the creditors would not trust this new profession. I would say, I would actually come to another slide where I would be actually talking about the transparency, and I will discuss with what my thought is. Average again of two valuers has to be appointed, and the average of the two will actually become the valuation, and the reserve price of the assets has to be fixed based on the average of two valuations, which is to be done either to be appointed by the liquidator or the earlier valuation done as per regulation 35 of the CIRP regulations. We are now coming to the practical part of it, and my senior partner Anil Agarwal would also add wherever he feels comfortable and wherever he feels any example that actually is relevant for sharing with the participants today. Major hurdles that we have faced so far that we have listed here is one, and bigger hurdle is the information and document. The first scenario is when the company is liquidated. Almost about a year back, the promoters were still having some interest in the company, and they were actually thinking that we will take the company back under section 230 of the Companies Act, or they even thought that they will talk to the bank, and the bank will invoke section 52, and then they would be able to take the asset from the bank under SARFAESI, and they would not cooperate with the liquidator. Now the situation is worst because all these gaps has been plugged. There has been a separate amendment which says that under section 230 of the Companies Act also, anyone who submits a scheme of arrangement or compromise should be at least eligible under section 29A of the IBC. Similarly, section 52, there are regulations added that in case it is there in regulation 21A of the liquidation process regulation, that in case the asset has been taken by the secured creditor under section 52, even after paying the CIRP cost, liquidation cost, and the workman dues, then the asset would not be sold to those people who are ineligible under section 29A. So that has also been mandated to the secured creditors. So that is now clear that in no way the assets can go back to the promoters. So information, when they have no interest in this process, they would not provide any information, and the information that the liquidator badly needs, and which may not come while he was RP, or that may not come from the RP who was earlier RP, and that is regarding the litigation, claims, refunds, receivables, the most of the information regarding sundry debtors is not receivable, not received, because see, the information is not provided to the liquidator with the fear of fraudulent transactions that might even get highlighted in case the information is not available or information is not correct. However, this is a very big hurdle that the information is not available. Books of accounts are not available. We are trying to get the books of accounts restructured through the bank statements. Then the second difficulty is the unrealistic valuations. Unrealistic valuations without even considering the industry status, without considering the demand of the product, and without considering various factors which are not. See, the basic concept all the valuers must understand that if there is a customer, if there is the market value, if the customer is available at X, if there are two customers available at X or Y cost, that is the market value. So they have to arrive at that value. They can't simply say that this particular land and this particular building can be sold at the circle rate or can be sold at this much of rupees per acre, but they have to consider that this is 600-acre land or this is 100-acre land. So there is hardly any customer for industrial lands of that large size. So they actually have to apply various discount factors, which of course we discussed yesterday in our webinar at 3:30 regarding valuation under IBC, and maybe that many of the participants today who are connected with us, they must have attended that also. So the third is the attachment of assets under criminal offenses, like maybe the PMLA, Coffee-Posa, or even the narcotics, or even the corruption. All this, wherever the assets are attached, or unauthorized investment schemes, or chit fund, or any kind of a criminal offense where the assets are attached either by the Enforcement Directorate, SFIO, or the economic offense wings of the state government, SEBI, or any other authority, income tax department, customs department. All these attachments may be against a civil or liability or against a criminal offense. Everything has now been clarified. Section 32A was inserted with effect from 28th of December 2019. That has provided big relief. However, in many cases, in fact, in 13 liquidation cases that we had all the assets attached, and we were only struggling before the appellate authority under PMLA or before even Supreme Court, even NCLAT. So we were struggling with a lot of litigation. However, once this clarity was clear, clarity was given on 28th of December, we filed some of the applications to adjudicating authority, and we got one order in the case of REI Agro from Kolkata bench, and the assets were de-attached, taking the advantage of newly inserted section 32A. Liquidation cost is also one of the very big hurdle. Despite various promises, despite various regulations which has been inserted by IBBI, the liquidation cost is not coming as a contribution from the stakeholders. The liquidator at times feels suffocated because he is not even able to take the protection of the assets. He is not even able to get money for the security guards, for the valuers, for the litigation, so the liquidator is also suffering because the stakeholders are not contributing, and if they are contributing, they are taking too much of time, and that entire period is lost. And later on, the liquidator would be blamed that you have not been able to complete the assignment within 12 months. This is, in case my banker friends are listening, please try to understand the liquidator's plight. Please try to understand his position. In case he is not able to work only because the liquidation cost, he got no money, then he would be blamed later on that he was unable to handle the liquidation assignment within 1 year, so he is getting the extension. At that time, in case it would be told to adjudicating authority in even roaring voice, the adjudicating authority would say that you could have come to us at that time. So in case today the liquidator goes to the adjudicating authority seeking direction against the stakeholders, that would be felt bad by the stakeholder, that the liquidator to whom we appointed, he is filing a case against us. So try to understand the position of a liquidator. In case he files a case against you for the recovery of the contribution to of the liquidation cost, then he would be considered as the person appointed by them and filing a case against them. So he would be having a bad name in the industry amongst the customers, larger customers. So in case he goes to the adjudicating authority after 1 year that he was not having any money for 6 months and he could not complete his job, then the adjudicating authority will tell him that you could have come to us at that time when the contribution was not coming. You have delayed the process, you have disrupted the process, you have in fact strangulated the entire process. So why should we give you the extension? So those kind of questions the liquidator is facing. So to all my banker friends, nobody can work without money. And nobody can even file a case against the customer who has actually appointed him. With this understanding that the liquidator is actually not able to do A, not able to do B. So he is simply requesting. So in case the financial institutions would not contribute liquidation cost, that means the entire hurdle is this part, which can be seen, which can be handled very easily, because whatever you are contributing, that is coming back to you as over and above your contribution, over and above, and that too also is carrying interest with the latest amendment under regulation 2A of the liquidation process regulation. Of course, the interest is very less, but that is equivalent to the money that you keep in the RBI, like in bank rate, 4.25 presently. That interest also you will get on this money. Customers not available, of course, is a bigger hurdle. That is, of course, that we are facing under SURFACE or even under insolvency. If the customers are not available, and we are not very keen to reduce the prices every month, because in case we keep reducing the prices every month without even looking at the customer, without even talking to the customer, without even developing them, then the customer will wait. Even if a genuine customer, he would wait for another month. He will wait for another month, and he will not participate till the time the price actually goes to a rock bottom price. So frequent reduction in the reserve price should not be resorted to. There is a possibility of reverse e-auction, and where the reserve price can be kept as a secret, and that can be discussed with the stakeholders and the liquidator, and the auction is opened. And in the auction document, it is mentioned that there is a reserve price which is protected with the liquidator and the stakeholders. Unless the reserve price is achieved, or unless an appropriate price is achieved, the liquidator has a right to cancel the auction. So in that process, everyone, whosoever is interested in that asset, they would come, they would put their own price, they would participate into the e-auction, and that would be a very, very good price exploration process. So the price can be explored in this manner, and the reserve price can be kept as a secret between the, and then in that would be a very big evidence also that the price was reduced based on a market information. So in case there is an asset where 8 people participated and everyone participated and there was a bidding, and finally the asset value achieved was only 75% of the reserve price. So that makes a very big reason for reducing the reserve price. And then even if we reduce the reserve price, and even the asset can be sold to those people who have given the bid in the last bidding. So that is what I'm trying to say, that reducing the price of the asset frequently is not advisable. Reason number 1, that the stakeholders are not comfortable with this process. Reason number 2, the genuine buyer who is interested in the property would like to wait further, because see, the only thing that we have to do is we actually have to talk to the customer, we have to develop them, we have to provide them comfort, we have to tell them that whatever you want to offer, you offer, and you give us in writing the offer, and that has to be along with the earnest money deposit. So the reverse auction without disclosing the reserve price is also will become very, very popular for exploring the price of an asset. Other part of the major hurdles, Anilji, I would finish these 5 or 6 whatever pending in this slide, and then I would speak to you, and I would like you to share some of the practical experience, even if you can take names of the companies, because most of these things are under public domain. So in various large cases, we are not able to find a customer, and the maybe larger piece of land, industrial lands are not in demand. We have too many lands like 600 acres, 900 acres, 1000 acres. Those lands are primarily allotted for a specific purpose. Now, even the state governments are not very clear whether they would allow the transfer of these land for any other purpose, or it was only specific to that particular project. That hurdle is a very big hurdle. One, that the industry segments like which are not in demand, we will actually have various such projects which are not in demand, like the thermal power plant, the plant and machinery is not in demand, rice processing units are not in demand, spinning companies are not in demand. So these companies, this industry is not in demand. So we are not able to find the customers for this kind of industry. Litigation also has been taken, it is taking a lot of time, litigation from the claimants, litigation and some kind of stay, because most of the claimants are going to adjudicating authority and to the appellate authority saying that our claim has been rejected and the assets are being sold. And unless our claim is accepted or handled or decided, the asset should not be sold and the money should not be distributed. Or some of the workers has been able to take some stay from these different high courts, and that our claim has not been admitted. So our claim has to be admitted to that extent, and the assets and the liquidator has been directed to stay the process. So there we have also got an instance in one case that we sold one asset. Rather, we in fact would put it on auction, and the auction was participated. But in the meantime, we could get a high court order where somebody produced in high court 1 lakh rupees of receipt that he bought this land about 3 years back from the company, and they have a right on this land, and how the liquidator can sell this land, and then this high court given a stay. So the litigation also is disturbing a lot, and the liquidator has to attend a lot of litigations. So more than 50% of the time of the liquidator is spent in the litigation. 25% is spent in preparing reports, and 25% is the only time that he is spending on the actual sale of the assets and developing customers. So this practical experiences must be seen, and then only the liquidation assignments may be taken up. Tenancy, we have already discussed that the tenants has a complete right. Third party interest, as I already discussed, that somebody is just producing a receipt to create a third party interest. Anilji, this is also one of the case which is very, very latest case, 3rd March 20, where of course this was a different case where the tenant filed a case that the liquidator sold the asset at a very, very low price. So then the NCLAT said that the tenant has got no locus standi. So that of course was done. Anilji, I think the various practical difficulties, hurdles, can you just share with the participants some of the examples?
Sir, like the 32A, we were facing a problem in Pincon industry. In Pincon industry, this is a case where the EOW attached the entire assets of the company, and the assets were in the possession of EOW. During we were the RP in that case, we filed application with the different High Court and even with the NCLT, but we were not able to get any good order during CIRP. But after the insertion of 32A, we were able to get the order from NCLT in Pincon. After getting the order from NCLT, we write to the EOW department to hand over the assets of the company to the liquidator. The EOW writers that please provide us the list of assets which are to be handed over. Since we do not have any document of the company, the registered office of the company was sealed by the EOW only. We were able to produce that list from the documents which were filed with the EOW, which were available with the EOW only. Yeah. So these are the we are continuously writing to the EOW for handing over the assets of the company, but till now we have not get any handover from the EOW in Pincon industry, sir. And even in REI Agro, we were able to get the order from Calcutta bench in 32A. These orders are coming, sir, but the main problem is taking the handover of the company and taking the release letter from the different authority. That is more important, sir. NCLT will give order, but the ED and the other department will take their time to give the release letter to the liquidator or the different or the RP.
Good, Anilji, thank you very much. So, Ankit, we have these slides that which are pending, that is regarding the attachment against the criminal offenses, and then we have the assets. Then we have how can we sell the private assets through the private treaty. Then we have the subject of going concern, and then we have the subject of after the going concern. Then we will go to the mode of sale, and then we actually will go to the tax part of the liquidation process. And in
and we
case
have
these
35
questions,
minutes with us.
leaving these questions, we can actually have some questions, because these questions of course will be automatically answered when this subject will taken up. So if there is any question regarding the with the which I have already conducted, I have covered, so those questions may be asked, maybe 2 or 3 questions.
So I think one question on PF is coming up. I think there is a question, and I will just put that up to you. This one is from. So there's a question that a coal mine land, say after mining is all a very large pit, and it has no value. It has only an obligation to fill it up with whatever is required to fill it up, because this is, I think, a compulsion that once you mine it, you have to fill it up so that it can have alternative use and it is not damaging the environment. So what do you do with that land? Is that an asset? It might be liability only, not an asset.
What I understand is whenever such land is allotted to any company, and then along with the allotment there, I think either the land allotment agency would take some kind of bank guarantee, or the land allotment agency would also take some kind of deposit. Otherwise, leaving this obligation open to any miner who is doing mining, and that would not be appropriate for any government agency. So in case the liquidator would not do that, so in case the liquidator will not fill that pit, very large pit, then that particular deposit or the bank guarantee would be invoked. So in case liquidator feels that by just doing this work, the liquidator would be able to save the bank guarantee or that kind of deposit, then the liquidator should take action.
Question was more to do with the sellability of this, whether this is an asset for the liquidator or not, and because the land will definitely come.
No, what I understand is that these lands are not owned by the corporate debtors, because the mining lands are not given to the companies on an outright sale. These are only the contractual rights. That person who is asking the question, he has to understand that these lands are not at all given on ownership basis. These lands are given on the use basis. So that is the reason I am saying if there is a contractual right, and that contractual right has a value, so that value can either be doing the compliances and then taking back the security deposit, or not doing the compliances and letting the security deposit or the bank guarantee be invoked. So that has to be the decision rather than selling this asset. I don't understand.
Then a question is that when we are talking of employee dues period of 24 months or 12 months, as the case may be, is fully payable or payable in same proportion as the secured creditors. For example,
payable in same proportion as it is being paid to the secured creditors, not full.
Okay. I think this one is done. So then, I think you can continue, and then I will just identify a few questions and we can take it up once you're through the remaining presentation.
So I'll resume, and this is section 32A, which was inserted on 28th of December 2019, which is very clearly saying that the liability of the corporate debtor for any offense committed prior to CIRP shall cease. The corporate debtor shall not be prosecuted for such offenses from the date resolution plan is approved. Even if the prosecution is instituted during CIRP, this section would be applicable. If any person or officer who is in default for the offense, maybe directors, who would continue to be liable for the offense and punishment, notwithstanding that the liability of the corporate debtor is seized, like the directors and the other key managerial personnel, they would continue to be responsible for the offense. No action shall be taken against the property of the corporate debtor in relation to an offence committed prior to CIRP if that property is a part of a resolution plan. So this is also applicable during liquidation. The only thing that we actually have to comply with the 3 conditions. So this is also very clearly mentioned that an action against the property of the corporate debtor in relation to an offence shall include the attachment, seizure, retention or confiscation of such property under such law as may be applicable to the corporate debtor. Now let us see the conditions for this section. The first condition is that the resolution plan or sale during liquidation process result in change in the management or control of the corporate debtor. This is the first condition, that in case we say that now the company has been given back because of MSME, it has been given back to the same promoters. So the offense is all, no, it is not, it has to be given to another person rather than the promoters. New management or the buyer during liquidation process is not a promoter or in the management or in the control of the corporate debtor or a related party to such person. The new management or buyer during liquidation process is not a person with regard to whom the relevant investigating authority has reasons to believe that he had abetted or conspired for the commission of the offense. These are the 3 conditions. So whenever we apply for any detachment of assets, we have to give these 3 undertakings, that the resolution plan would not be taken from such persons, the asset would not be sold to such persons, and also we will take care of those persons who have who as per the report of the investigating agencies reasons to believe that they have abetted or they conspired the constituencies. So this has been held by, in the case of Tata Steel, Bhushan Steel case, dated 16th March 20, it was held by Delhi High Court that the new promoters are not responsible after this section 32A is inserted. In another case, which is JSW Steel Limited versus Mahinder Khandelwal, that was in the case of Bhushan Power. So both the cases of Bhushan Group, it has been decided that whatever offences was committed by the Bhushan brothers, those who actually will stay with them, and the resolution applicant, successful resolution applicant, would not be impacted adversely because of the offences committed by the earlier management. So this was the section 32A was again considered as like it was considered as a kind of retrospective, so that all other cases are also considered to be equally getting the benefit of these cases. Like we have taken an order in the case of REI Agro, like the name of the case is Surendra Kumar Joshi versus REI Agro, where I am personally looking after as a liquidator. So we got an order from Kolkata bench, and it is held that the ED, the liable to be detached by the ED and handed over to the liquidator to enable the liquidator to handle the property as per the provisions of insolvency and bankruptcy law. Sale of the asset, regulation 32, we have already seen, like clause A to clause F, and then we can now talk about the sale as a going concern. Regulation 39C, which was again inserted with effect from 25th of July 2019 in the CIRP regulations, which says that while even approving a resolution plan or approving a resolution for liquidating the company, it is the obligation of the committee of creditors to decide whether the company would be sold as a going concern in case of liquidation or not. And that obligation has to be complied with by the committee of creditors and has to be submitted to the adjudicating authority, because nobody knows whether the adjudicating authority would approve the resolution plan or would recommend the company for liquidation. So in case the adjudicating authority recommends the company for liquidation, then this particular resolution would actually be kept in mind while passing the order for the liquidation. So this is an obligation of committee of creditors to pass this resolution, whether the company would be kept as a going concern or not. So in case yes, then what all group of assets and liabilities would be kept as a going concern, and what all group of assets and liabilities would be sold otherwise. The whatever the recommendations would be, that would be submitted to the adjudicating authority by the RP. Now, sale as a going concern, the process of sale as a going concern is that one, that it should maximize the value. The group of assets and the liabilities has to be identified. Practically, the liabilities are not being clubbed together with the assets. Practically, only assets are being sold as a group, as a company as a going concern or as a business as a going concern, but the liabilities are not being grouped. So so far the practical experience is that the liabilities are handled separately, settled separately, and the companies are asked to take fresh loan for acquiring the assets or acquiring the business or acquiring the company as a going concern. So the liabilities are not being transferred. However, the original thought process, which even might be possible in coming times, because when there will be hardly any customers for cash, there may be lot many questions who would be interested in continuing the business or entering into the business. They would like that the liabilities also should be transferred to them at a reduced value, so that they use their entrepreneur skills to revive the company and to again get the value back. So the sale as a going concern, it has to be now as per the regulation 32A. It is a kind of in most of the orders wherever the company is a going concern already and wherever the operations is continuing, and most of the orders for the liquidation, we have seen that the liquidator is being directed by the adjudicating authority to keep the company as a going concern. So if the company is being kept as a going concern, then the liquidator can keep the manufacturing. See, I'll give an example today, because see, the assets of one of the company, which is Varsana Ispat Limited, is attached by PMLA. And this, I think for the last 27 months, we handled CIRP and then liquidation. However, the assets of the company are very good, and it is a steel plant, and we are doing a turnover of 1,000 crores per annum. And that company is incurring profits. So we have recently distributed money to the stakeholders out of the profits. So what we are trying to say is that even during the liquidation, we are actually trying to keep the company as a going concern, and that is what is the intention. Now, when the assets would be detached after the lockdown is over, then that company would be sold as a going concern. The liquidator is like, however, the liquidator has to keep the company as a going concern for 90 days unless it is extended, unless there is a proposal, the liquidator can even extend it. However, for minimum 90 days, the liquidator has to keep the company as a going concern. So in case the liquidator is not able to find any customer, then the liquidator may decide to sell it otherwise. So this is regarding section 230 of the Companies Act. I will also come to the steps to be taken by the liquidator and two scenarios. One scenario is under section 230 of the Companies Act, and the other scenario is the keeping the company as a going concern. The judicial pronouncements on the sale of the company as a going concern and scheme under section 230, it started with S.C. Sekran. It is an Ankit judgment, and then followed by the Y. Shivram Prasad, and also these are all the judgments are in February and July. So these judgments are basically from Ankit. So these judgments are also based on some of the observations made by Honorable Supreme Court in the cases of Swiss Ribbon Private Limited versus Union of India, Megal Homes Private Limited versus Srinivas Girni KK Smriti and others, ArcelorMittal India Private Limited versus Tish Kumar Gupta. And these observations made in these orders by the Supreme Court, followed by the Ankit orders, then it became almost practice that for each case, the liquidation order would mention that the liquidator will try to will make efforts for any scheme of arrangement or compromise under section 230 of the Companies Act. So in case the liquidation process is started and the liquidator has got a scheme of arrangement or compromise under section 230 of the Companies Act, then it is the responsibility of the liquidator to take all those steps which are mentioned in section 230 of the Companies Act. Now, what section 230 of the Companies Act says, that whenever a scheme is received by the liquidator will file an application to adjudicating authority directing the creditors to convene a meeting and take a decision on the scheme. So after the directions from the NCLT, then the committee of creditors will appraise and will either approve or reject the scheme of arrangement and compromise under section 230 of the Companies Act. So in case the scheme is approved, then the liquidator will submit that scheme duly approved by the committee of creditors to the adjudicating authority. whatever is offered there, that will be considered almost as a resolution plan, and the company can be taken over by the person who submitted this scheme based on this scheme, which would be approved by the NCLT, and it will be implemented just like a resolution plan. Now coming to the procedure that would be followed while the company is being sold as a going concern. Now I will actually do this as an example. In the case of say Varsana Ispat, there is a complete plant that we have, and we can sell this plant separately. In the case of Birla Cotton also, there are multiple factories. We actually would like to take one factory as a going concern and the balance factories on a piecemeal basis. So we will advertise, and if there is a customer available, that customer will submit the bidding for the purpose of taking over the company as a going concern. The liquidator will keep all the non-core assets, and all those assets which are grouped as a going concern, that would be sold as a going concern, and the name of the company would also be given to them. Now, how the name of the company would be given to the buyer or bidder? So the company, the existing capital of the company would be kept with the liquidator, and those are subject to the claims submitted by the shareholders or preference shareholders, because those shares cannot be given to anyone, because the liquidator has already received claims from the shareholders. Because as I would like to remind you that during liquidation process, even the shareholders are also supposed to file their claims in case they are expecting any money from the company to that kind of distribution hierarchy. So therefore, the liquidator has got no power to extinguish the existing capital or transfer the capital of the company. So the liquidator will only ask the bidder to contribute fresh capital to the company, and the fresh capital would be allotted, and they would become the members, and then they would become the the adjudicating authority would approve the resolution plan, or what the sale plan, which actually would be equivalent to the resolution plan. All the terms and conditions like a resolution plan would be there. That would be submitted to the adjudicating authority. Adjudicating authority would approve it, and that in that same order, the adjudicating authority would also pass a couple of further orders, that so and so assets would be retained by the liquidator for liquidation or for recovery. Second, the liquidator would be entitled to retain the liquidation bank account of the corporate debtor, and all the proceeds of the sale of the assets or recovery from the assets would be debited to those accounts, or that account would be used for the recoveries or from the realizations and for the distribution of the then the company, once the liquidator finishes the process of sale of other assets, recoveries from the other assets, other litigations which are kept pending with the liquidator, and only the assets has been taken over by the bidder. Then after that, the final application would be submitted by the liquidator, and that would not be for dissolution, that would be for closure of the liquidation process. So this is the difference between the liquidation and dissolution of the company, and the liquidation and sale of the company as a going concern. So this is the these are the practical part of the process of the sales of a sale as a going concern, although it has not been given anywhere in the regulations, like the process of sale as a going concern. So this is only out of the practical experiences, logical thinking, and also what are the other options available. So the process I have already discussed, process as a going concern. So coming quickly to the concept of the mode of sales. As I said that the e-auction, everyone understand how the e-auctions are to be done. Price fixation, and that is also easier to handle. The public announcement has to be given. All these are Regulation 34 and 35, and also Schedule 1, which is referred in Regulation 33. This all actually is the mode of sale through e-auction. And then the mode of sale also talks about the multiple rounds of the bidding and the permissions of the AA. So whenever there is a sale to the related party, that has to be permitted specifically by the adjudicating authority. Otherwise, there is no possibility of sale to a related party, related to liquidator, related to CD, related to any directors. That has not to be done. That is not possible. The adjudicating authority would not give any kind of approval. Sale would be closed only on the receipt of full amount. The liquidator will execute the certificate of sale and sale deed also. So we have done registrations for multiple properties. We sold the properties, issued certificate of sale, and then finally the sale deed is registered by the liquidator, and the liquidator will sign as liquidator in his personal name. And he is not the owner is the company, but the liquidator is signing because the liquidator has the power under Regulation 33, Regulation 34, and Regulation 35. So Regulation 33 and 34. Regulation 35 deals with valuation only. It has been very recently in February 2020, ANCLAT has also held, once the liquidator is sold a property, the other bidders has got no power to go and approach the NCLT, and they cannot create a dispute. The adjudicating authority is not to direct because even if there are some, the code empowers liquidator to sell the property of the co-debtor in liquidation by public auction. Hence, there was no need for adjudicating authority to direct the liquidator for considering the proposal of respondent 2 and respondent 4. These are other parties who has approached the adjudicating authority after due date of the finalization of the auction. So that means the auction is finalized, say at X price. Somebody who actually felt that this property should have been acquired by me, and he was waiting at that time, and later on he had approached adjudicating authority that this particular property was sold at a lesser price, we are ready to offer more price. The adjudicating authority has got no power because the liquidator has sold it in an e-auction. In case we try to do that, then in all the kind of auctions, everyone will come that I can pay 10% more. So that matter is closed by ANCLAT, that nobody can approach court that I would be able to offer something better than what liquidator recovered. So that is also the closed part. Private sale. Yes, private sale is also possible when either there are conditions, there are in fact any one of the 4 conditions. One is the asset is perishable, the private sale is possible. When the asset is likely to deteriorate in value significantly if not sold immediately, private sale is possible. Asset is sold higher than the reserve price of the failed auction, the asset is possible. Prior permission of the adjudicating authority is not required. I would refer to the regulation, and the private it is not required. The private sale, the adjudicating authority's approval is not required. Where the asset is to be sold through private sale, liquidator shall conduct the sale in the manner specified in strategy. Private sale, the stands completed. I mean, no permission of the adjudicating authority is required. So the private sale is possible. Now the colluding sale is also defined there, that whenever the liquidator feels that there has been a cartelization or collusion between the parties, then he can report the transaction to the adjudicating authority and get the transaction cancelled, even if somebody has bidded at the reserve price or for more than or at a price which is more than the reserve price. The liquidator has the power to get this cancelled from the adjudicating authority. These are some of the recent amendments which are significant. The liquidation process has to be completed now in 1 year as against 2 years. Regulation 44 has been amended. The period for exploring sale as a going concern, that would be excluded from 1 year period. In case the liquidator fails to complete then an application within 1 year, then the application can be filed before the adjudicating authority for extension. Section 29A is also applicable to scheme of compromise or arrangement we already discussed before. Regulation 37 provides that the secured creditors who have not relinquished security interest would not sell the asset to persons ineligible under Section 29A. So these are these various amendments that has actually been given. Schedule 1, which handles the sale process, now also has been amended. Reserve price is based on the valuation. The first after the first auction, the price can be reduced by 25%. For subsequent auctions, the price can be reduced by 10%. The amount of the bid can be received now in 90 days. However, after 30 days, 12% interest would be charged from the bidder or from the successful bidder. Sale can be cancelled if money is not received. Now, Ankit, I'm going towards the different part, which is the transparency, and we are already at 5:49, so we should not have actually more than 2.5 hours. But this is a very, very important part that I would like to share with the
I think you can
participants.
complete this in the remaining time that we have, and for the unanswered questions, we have tried to answer the questions. We have tried answering about 55 questions about the 160 questions that we have received. So it would not be possible to answer these 106 questions, but might be it is more important to cover what you have planned to talk about.
So like see what I think, and I believe that most of my liquidator professional colleagues, they would also think the same way. So this is the first time in the history of country that a private professional has been trusted so much by Government of India. If you understand that presently we are handling assets worth maybe 20,000 crores, and those are to be handled by us. We have to sell those assets, and we have to recover the money from so many people. All this is a matter of trust which the government has posed on us. So in case in case we don't use transparency in our efforts, in our actions, in our process, then there will be unrest amongst the creditors, amongst the secured creditors or other creditors. See, to avoid that unrest, what a liquidator, what a liquidation professional should do. So one is that the transparency has to be maintained. The efforts that he's making, the process that he's following, that has to be shared with the stakeholder. Even if it is not provided in the law, even if the stakeholders consultation committee has no power, but in case you don't provide this transparency, one, that the stakeholders would not feel comfortable with you for the next assignment. Second, they probably also would not have trust on the liquidation process. What we do for assuring transparency in the liquidation process, I'm just trying to share with you. Number one, that we regularly share our progress reports. And in fact, we have introduced monthly progress report for each liquidation case. And we are sharing with all the creditors, irrespective of the fact that creditor is a member of the stakeholders consultation committee or not. We share with those people who actually can be a stakeholder in this company, who are expected to get some money out of the company. We share with all of them, whether they're members of the SEC or not. So even monthly report, even progress report, which is quarterly, that we share with them. So we hold frequently the SEC meetings, and we share with them the progress, litigation, efforts, hurdles, lack of information, everything we share with them. As I said, monthly progress report, quarterly share. See, just like COC, even the appointment of professionals, even their professional fee, that also we are discussing for the purpose of transparency. So like this appointment of brokers is a very, very tricky issue. So in case we have a property to sell, and in case I appoint a broker, the stakeholders will always consider, and they would always have a kind of apprehension, and whether this lead first came to the liquidator or the lead came to the broker. Maybe this is a case where the liquidator is passing on his leads to the broker, and the broker is making money and sharing with the liquidator. So therefore, that we have never appointed a broker in any of the cases of the liquidation. Why is so? Because see, if the asset is 100 crores, and if the commission is only 1%, it becomes 1 crore. The commission becomes 1 crore, and that is sometimes even more than the liquidator's own fee. Because in many assets, when we actually cross 6 months or we cross 12 months, and our fee is much lesser than the broker's fee, then the liquidator actually would be not be the stakeholders would not be comfortable, because they would have no information about the lead's first source of the lead. So we are not appointing brokers. In case we are appointing with the permission and consent of the stakeholders. Sharing of the deals. See, like we are completely electronic now. Each and every call that we receive on the sale of assets, we are actually receiving it on a digital mobile number, and all the leads are recorded in a lead management software. And each and every asset and the lead and the mobile number of the lead is shared with the stakeholders, they are at the liberty to call those the leads. They can even ask whether the information was provided to you by the liquidator. They can even ask about the marketability of the asset and what price they are offering. That would actually give a lot more comfort to the stakeholders, and the trust in the liquidation process would be enhanced to a great extent. So if this is done, if this kind of transparency is done, if the entire information which is required by a buyer is collated on a virtual data room, if you can create an evidence that the entire virtual data room was shared with them, if you can just create evidence that yes, each and every information was provided to him, then no prospective buyer, no bidder will talk negative about you, and anyone can even talk to those bidders. There is no hurdle that you should not share the mobile numbers of the leads to the stakeholders, because see, in liquidation they can't withdraw, because even if they get a customer, the asset has to be sold through liquidator only. If a customer comes to stakeholders, creditors, they actually send it to you. So in case a customer comes to you, in case you also send it to the bankers, there is no difficulty in your process. Rather, in SURFACE at times it is different. In SURFACE, like we also feel difficulty that in case we share the prospective leads to the bankers and the lead goes to the banker and the banker thinks that they have not got the customer, so they can even withdraw the case from the SURFACE agents or from the resolution agents. Whereas in the liquidation process, the banks can't withdraw. Even if the customer comes to the bank, they actually have to sell it through the liquidator only. So sharing of the information is something which is very, very important. The litigation challenging the decisions of the liquidator. This is the liquidator can reduce the reserve price. That all the liquidator's powers are upheld. Liquidator's powers are upheld. So far, there is no challenge on the liquidator's power in fixing the reserve price, reducing the reserve price, selling the asset on e-auction, even selling on the private treaty based on a particular process. So far, the adjudicating authority has not actually challenged the liquidator's actions. Now coming to the infrastructure required for effective liquidation process cases, effective management of liquidation process. One is the, I'm very clear about one process, that the CIRP and liquidation, two things have got nothing common. In CIRP, hardly the litigation on the corporate debtor is not there, the outside litigation, because in CIRP, the outside litigation is not there, whereas in the liquidation, even the outside litigation, high court, arbitration, tax proceedings would be resumed and would be restarted. The sale of asset is a completely different capability and requires differently trained human resources. Then secondly, making recoveries from the debtors, advances, claims, arbitration, investment, it requires differently trained people, different than those who are handling the CIRP cases and handling the COC meetings, and these people are different people. Preservation and protection of the assets, like you would see, it is very important to know that presently, like we are maybe handling 100 locations where the assets of the corporate debtors are located, and we have to depute security guards there. How many agencies are working? Maybe about 50 security agencies are working, because we normally take agency which is locally situated, the security agency. See how to control their behaviors, how to watch their guards, how to count their number of guards, how to see whether they have whatever they have committed they are delivering. It's a very, very challenging job. Very, very challenging job. How would you make sure that they are not stealing small parts of the components? All this is a very, very challenging part. At times we have installed cameras there at the locations. We have also a separate team which is handling the inspection, and that too without even telling them that we are surprise inspection of the sites. And in case we find lesser guards, then we deduct salary from the security agency for at least 1 month. So these kind of experiences that we have taken from SURFACE for the last 17 years, that are being used in liquidation also. The different manners and modes. See, all this is the infrastructure which is required: lead generation software, lead management software, due diligence by the customer through the VDR, all this infrastructure, confidentiality about the bidders, collection of earnest money deposit, frequent price reduction, as already have discussed that it is not suggested, role of security guard at site, specialized agencies that we are using, that we have now found agencies, they specialize in scrap, they specialize in construction scrap, they specialize in textile machinery, they specialize in construction equipment and motor vehicles. These kind of agencies are being hired for selling specialized assets. So all this infrastructure has to be created. For investments, we have to take the control on the demat account. For sundry debtors, it's a very, very different team that is required to recover money from different sundry debtors. For claims, for refunds, for investments in the subsidiary companies, the avoidable transaction application also has to be handled by the liquidator. So this is the entire process where some money is expected to come. It requires a completely a different set of teams. And I could not use the same team who is using the CIRP, who I'm using the CIRP. So I'm training the team for liquidation separately and training the team for CIRP for separately. And we have a separate asset sale team. We have a separate security management team. We have a separate technology team, which is actually creating some kind of attendance records for the guards, so that the attendance records are also created electronically. But that actually is becoming difficulty because most of the guards are saying that we don't have the mobile phone. Or we don't have the connection, or at these remote areas, the connection is not there. So a lot of difficulties, because see, how to manage 50 security agency companies is a Herculean task. I'm trying to share with you that yes, it is not possible to achieve perfection, but yes, we are trying to make efforts that yes, some kind of accuracy or some kind of perfection is achieved, at least to some extent, at least better than others. So that's what we are trying to say, that the liquidation process is completely different. In various cases, we are also trying to manage performance bank guarantees, default liability, retention money, security deposits. So in case we don't make these efforts, that means that you are actually not trying to recover the money of the corporate debtor which belongs to the stakeholders. In case you are not protecting the bank guarantees of the banks, in case you are not providing service to the beneficiary, then also it is not a justice to the job. See, we are presently doing the default liability. In one of the cases, the company is in liquidation, and then there is a default liability. That particular company constructed some roads, and as per the contract, the company has to maintain the road for the next 5 years. So in case the company is not maintaining that road, then the bank guarantee, which is substantial amount, that would be invoked, and the bank will suffer that amount, and the money will go to the beneficiary customer. So in case we do that expenditure and do that repair, then we can actually save that performance bank guarantee, and that would be a very, very comfortable to the stakeholders. Similarly, retention money. See, that there is a possibility that the retention money is recoverable only after 2 years, and for 2 years the liquidator has to give some kind of warranty assurances. So the liquidator is giving some kind of warranty assurances so that that retention money is taken back and distributed to the creditors. So for each action, we actually have to make assets and liabilities. In case the expenditure is more than the recovery, then of course we can let it go. In case the expenditures are less than the recovery, then we should actually make the expenditure, save the asset, and actually the net profit should be distributed to the stakeholders. Same is the situation with the security deposit. So as we said, that the recovery, the liquidator has the power to recover the amount, and the liquidator has also the power to file an IBC case. Section 11 of the IBC was amended. Now the liquidator can recover the amount, and by just filing the applications under IBC. The management of the subsidiary companies by the liquidator is also been held as a right to the liquidator. The judgment called Rajiv Kaul versus Vinod Kumar Kothari, and dated 20th of March 2020, NCLT Delhi has held in the case of Nico Corporation that the liquidator has the right to appoint nominee directors and take control and custody and on the operations of the subsidiary companies. That has also been held very, very clearly. Asset sale report we have to submit, and finally distribution is also supposed to be given, a recovery of the money. Like this is also regulation 2039 is also very helpful. In case we disburse some amount to the stakeholders which are wrong, or which becomes wrong on any event in future, the money can be recalled from the banks under regulation 39. This is all we have discussed, section 52 of and how the 52 is invoked. the process of sale, and in case section 52 is invoked, I have to discuss what are the tax implications during liquidation. One, section 178 of the Income Tax Act is not applicable to the liquidator. So the liquidator is not supposed to go to the assessing officer and take permission from the assessing officer. Liquidator can directly sell the asset because section 178 is not applicable. Section 46 of the Income Tax Act says that the capital gain on the distribution of assets by the companies under liquidation will be taxed. And that means that the no asset, when it is sold, it cannot be taxed. Only in case that the money realized from the assets is sufficient to the extent that some amount is distributed to the shareholders, then the shareholders will pay tax on that money which is distributed to them against their shares in the company in liquidation. So the company would not pay any capital gain tax on the sale of assets during liquidation process. Income tax provisions which are applicable, as I said, that the section 288, which provides that the authority would be provided to RP and the liquidator to appear before the income tax authorities. Now the income tax, this was an amendment dated 1st of April 2020 with effect from in the last budget. We have actually got this amendment that under section 288, even the liquidator or the RP, they can appear and they can appear before the income tax authorities as authorized representative. Section 140 now provides for the verification of return of income, and it can be even authorized by the RP or any other person as they may prescribe. That amendment also would be with effect from 1st of April 2020. And there was an amendment earlier which was made with effect from 1st April 2018, where only RP was authorized. But now also the liquidator is not authorized, but it is only said that this power has been taken by the central government from the parliament, and the central government by notification can also authorize or can also make other people eligible for verification of the return of income. The section 56 subsection 2 and clause 10 of the Income Tax Act is also amended, which provides for the chargeability of income in case of receipt of money or specified property for no or inadequate consideration. Section 50CA of the Income Tax Act provides for the deeming of the fair market value of unquoted shares for computing the capital gain from the transfer of such shares. Both these provisions, the fair market value is determined based on the prescribed method. Currently, the provisions of section 56 to 10 are not applicable to certain specified transactions. However, no such exemption is available under section 50CA. The budget amended these sections to empower the board to prescribe the transactions undertaken by certain class of persons, and we expect that since the central government has taken this power, we expect that the transactions which are actually being done through IBC, either as a resolution plan or as a liquidation, that would be notified as the transactions on which section 56(2) subclause 10 or section 50 capital CA would not be applicable. So I said that the capital gain tax would not be levied on the sale of assets during liquidation. Capital gain on the sale of asset during liquidation is because these are all the reasons which we are saying that the capital gain tax is not applicable on sale of assets during liquidation. And there is one case also, Ms. Pooja Bari versus G Ispat Private Limited, NCLT New Delhi, has held that the tax liability is not there. And even if there is a tax liability on sale of assets, that would be distributable as per section 53. So in case there is a company which has got a lot of money and the company is in liquidation, on the sale of assets, the capital gain amount, that also will be taken as a claim from the income tax department, and that claim will be addressed as per section 53. That's what is the mandate of the court. GST is applicable on the sale of the assets under liquidation, because this we have seen the GST, the schedule 2 of CGST Act, paragraph 4A. The transactions are taxable under GST. Wherever there is any sale of asset, GST has to be charged. Input tax credit would be available. The tax authorities, of course, they can file their claim. They have their right to be in the stakeholders consultation committee. They have no power, as SEC doesn't have any power except to see the sale process, and that too restricted to Regulation 32. Pending assessments. Although this subject is a very, very large subject, and I have a separate webinar on the tax treatment of IBC and the liquidation, I would recommend that for all the tax questions, in case you can refer to my recorded webinar, which is available on the YouTube channel of AAA Insolvency Professionals. That is a very, very detailed analysis of income tax provisions, the IBC provisions, and regulation. And those deliberations in that webinar is very, very conclusive deliberations, and that would be very, very good in case you have any questions on the taxability of various income tax or GST. One thing that I can say, that the GST on sale of business as or a company as a going concern is not applicable. If the business is being sold as a going concern, then GST is not applicable. Nothing to say TDS and TCS provisions are applicable during liquidation process. All the payments that liquidator is making, the liquidator has to file TDS returns, and liquidator has to comply with all the TDS laws. The proceeds of the liquidation would be distributed as per section 53. And then I think we have already finished our, the only thing that I regret today is that as far as this taxability part is concerned, how to handle the claims of statutory authorities, tax during liquidation processes, that has not been completely deliberated me, because already we have, we are having 2 hours and 41 minutes since we started. And still we would like to take at least a couple of questions which are very, very important. And for the tax, I also could force close it, because we have a recorded webinar already, because the webinar that we do a couple of weeks back, that is available as a recorded version. So that is still available on the our YouTube channel. So that can be seen for the tax issues. So Ankit and Mr. Anil Agarwal, so anything that is coming in your mind which you feel is important, so we can discuss for another 5 minutes, and then we would like to complete. So I will stop sharing my screen now, and we can speak about for some time.
So there are a lot of questions where people. So there are a lot of queries that come in that the assets are not there. What do we do? The assets are not traceable. So I think the only answer, you've already answered that in previously also. Then there are a few questions on MSME, whether with the change of definition, some MSMEs which were not eligible earlier will become eligible under insolvency law to under various sections to take care of or
I think this is an important question. This is an important question. In case the MSME definition has been changed, yeah, in case the MSME definition has been changed with effect from 13th of May 2020, then it's a very, very important question. Like in case I have an asset and that particular company is an MSME as per the revised definition, then those promoters become eligible under section 29A. So would that be considered as eligible promoters, or can they buy themselves or not? That is a very, very big question, because like we actually have to see what is the eligibility as on the date of the sale or as on any other date. To my understanding, when we actually see the eligibility of a person under section 29A, that has to be seen as on the date of the transaction, not before that and not after that. If today we are selling a particular asset to any person, we actually have to see the eligibility of that person today and not in the past. So according to my understanding, if the MSME definition is revised and we are selling the asset today to a person who is now eligible under section 29A because of MSME, because this certain 3 clauses of section 29A is not applicable to MSME as per section 240 of the IBC. So that should be eligible now.
Then there is a question that considering, this is from Mr. Rajesh Kumar, saying that considering the present situation, whether SEC can advise liquidator to put auction of the property on hold till situation of COVID normalizes, as there will not be any buyer.
Generally, see, like I'm not talking about the powers of SEC. I'm only talking about the why the liquidator would like to sell in a scenario when nobody would like to buy. When there is a lockdown in the country, and tomorrow if somebody asks a question that you had only one customer with you and you wanted to sell it to the same person, that is the reason that you conducted the e-auction during lockdown, and that is not compliant. That actually is questioning the ethics of a liquidator. So why should a liquidator do that? And why should he do that? Even for his fee, this period would be excluded. So why should he do that? So he should do that only when the public is ready to bid, when the public is certain that yes, the country is going to open, and then they would bid only. So there is no reason that a liquidator should bid it during lockdown period. No reason.
So then a question is with respect to valuation. So if say during liquidation you get the assets revalued, and say the assets are valued by the valuers at a much lower amount than the CARP amount. So the question is, can the reserve price be fixed at a higher amount as compared to the liquidation values given by the valuers appointed under liquidation? So can the liquidator choose which valuations to use?
In most of the CIRP cases, in most of the liquidation cases, we see in most of the liquidation cases, we prepare a comparative chart of the valuations done during CIRP, valuations even done before the CIRP by the bankers, and the valuations of the liquidation, valuation during the liquidation process. Then we take the feedback of our asset sale team, and in case we find a customer, that customer is available at some higher price, then we fix the reserve price based on the market feedback, and that can be much higher than the reserve price as per the valuers under regulation 35 of the liquidation process valuation. So the liquidator has all the powers to sell the asset, fix the reserve price, which is much higher than the reserve price as per regulation 35.
Then there's a question on what is the quorum for a SEC meeting?
The quorum for SEC meeting is not defined. However, any decision which the SEC has to take, that is 66% of the people present and voting. So there is no process of voting share. There are total maximum 11 members are provided under SEC regulation. And out of the 11, 66% collectively should say one thing, and that should be present and voting. So in case 66% people say that no, the liquidator should not sell the company as a going concern, then the liquidator has to give a reason in writing why he still wants to sell the company as a going concern. And then 66% has to be people present and voting. So this is the law. So there is no voting share for SEC, and there is no quorum for voting for SEC. And the SEC, and the law says that the liquidator can even take consultation from one member. However, the only condition is that even if the liquidator has taken consultation with one member, whatever consultation that he has taken, that has to be circulated to all the stakeholders, members of the SEC. That is the law.
So there is a question from Mrs. Bharti Daga. It is, in one case, the company won a case in the High Court of a property, and the asset is in possession of third party who acquired right from an asset reconstruction company. Now, can we take the custody, and if yes, how?
Now, in case this asset is owned by the company by way of any court order, then the liquidator has all the powers to take control and custody of that asset. So in case that person is not cooperating, then the application may be filed to the adjudicating authority for directing the local authorities to get that asset in the possession of the liquidator. Anilji, you can also read some of the odd questions, and then I think this is very, very important. Still, we see that lot many people are still connected with us. So they are actually interested in the question answer session. So we still feel that only 25% of the people who actually joined us maybe have left, but still substantial participants are still connected with us.
Request our panelists to repost their question in case it is not answered so far, because there are many questions and the people who are available right now can perhaps put in their question. So one question is again the process of scrap sale or the assets that cannot be sold, the process of disposal of such assets and disclosure requirements for the same. I think you have to document that you tried selling them, and then if you've not been successful in creating a market, and then end of the day selling it to the best buyer after an auction.
Yeah.
I don't know.
No, I think this is okay. Like what you are saying is correct, and there is a concept of if you will read carefully, there is a concept which is provided in the law, and that concept is I'll just read out that section.
Then there were questions on changing liquidators and what is the. Then there were questions on changing the liquidator.
There is no process of changing the liquidator. It has to be changed by the IBBI only. In case the stakeholders are not comfortable with the liquidator, they only have one option, that they will file an application to IBBI. IBBI will do this investigation whether the liquidator is compliant or not, whether the liquidator is indulged into any kind of unethical practices. Then the IBBI will recommend change to the NCLT, and NCLT can take a new liquidator from the panel that they are maintaining with them. Otherwise, the SEC as such doesn't have any power to remove any liquidator.
Then there's a question from Mr. Dilip Kapoor. Can a suspended director, can he settle the dues with the financial creditors in its personal capacity, thus affecting the waterfall mechanism of the composition of COC? I answered a while back.
I think I also answered this VB Raju's question, and that's a similar question. Like in liquidation, the promoter settled with the bank, and the banks are not even listening to the liquidator now. This is non-compliance, and the banks has to give the asset to the liquidator, and the bank cannot do OTS during liquidation process.
But however, if the settlement is not from the assets of the CD, what will be the case in that? So that is a different case. That
no, I think we are not dealing with the assets which are not owned by the CD.
We are only talking about the assets of the CD, right? So
yeah. Any other asset, the banks are free to do anything. They can invoke section, they can invoke SURFACE, or they can do OTS. That of course they can go to the RDB Act.
Then some people have a question on Regulation 35, that how the 35 is structured in a way that it says that the valuer under liquidation process needs to be appointed within 7 days. And some people are saying that even if you want to, so how do you appoint a valuer after 7 days? And that is the question.
The valuer can be appointed after 7 days, because in many cases the SEC doesn't agree, or in case the SEC takes a decision finally, like consent of the SEC should be there. So valuer can decide at any point of time also that the valuation should be done afresh, in case the valuer feels that the valuation is absurd and he is not getting a customer. Even at that time also the valuer can decide that the valuation can be done afresh.
Then the question from Sivarama Prasad Bharmidi, and he's saying that does the gratuity accrued or payable forms part of workmen dues along with their wages? If eligible, is the entire gratuity or 2 years portion of gratuity eligible?
The gratuity is never for 2 years or 10 years. Gratuity is given to the employees on their discharge, on their termination, on their resignation. And there are basic conditions, like if a person has already completed 5 years, then the gratuity would be given as per the Payment of Gratuity Act. And whatever would be the gratuity as on the liquidation date for all those employees who have been discharged from the duty, that gratuity amount will form part of the workman dues or the employees dues, whatever the case may be. And then it will actually be settled along with the other dues. Like if it is a workman dues, then it is a pari passu with the see, like why it is so, because everyone says that any employee should not feel protected in the company, that his salaries would be paid even if the company goes into insolvency. Because see, the intention of the legislature is that even if the employees also will suffer in case the company goes into liquidation or company goes into insolvency. So the legislation wants that anyone who actually sense some kind of default in the company should be reported. So the earlier detection of default is the basic strength of insolvency and bankruptcy law, that the default can be reported by any person, and it may be an employee, because the employee also will suffer a lot in case the company goes into liquidation, and in case the company goes and incur losses for many years, and then later on the employee's salary also is not protected.
Then there is a question on so basically somebody is asking that, okay, we have answered leasehold land, so somebody is asking that what if the CD has the rights to a lease, so basically maybe a 10-year lease, so only a contractual right of some asset that was taken on an operating lease by the CD as a lessee. So I think even that will be a contractual arrangement that can be passed on to some buyer in case he's interested. That is what I think.
Yes, if any of the asset of the company is given to any other person on lease, then the lessee is protected, and it cannot be the lessee cannot be told to vacate. The only thing that you can do is that you can sell the asset along with the contractual rights.
Then there's a question on Section 138 of Negotiable Instrument Act and how the liquidator will has to deal with it in case there is an order from the court with respect to payment of those dues.
Though even if the order is there, even if there is any order or arbitration order or any court order that the payment should be made, and that payment, the claim would be admitted under Section 53, and it would also be mentioned in the claim that the priority and the under which clause the priority of that person is. If the claim is against an operational debt, then it would be as an operational debt. If it is a workman due or an employee due, that the nature of the claim would be same, irrespective of the fact whether there is an order from the court or not.
I am not sure if there is a clause in Income Tax Act to set off a tedious liability with an income tax refund.
No, I don't think there is a clause, but the income tax department has a power that they can adjust their refunds with the income tax demands. That power they had. I think we need to see any judicial pronouncement where the liquidator can claim a right on the refund, irrespective of the existing demand in any other assessment year. That kind of order we can wait, but for the time being, since there is a separate section where the income tax department is empowered to adjust their refund of any earlier year against the demands of any earlier year. Of course, there is a consent that they have to seek from the assessee, but in this case, the consent would be sought from the liquidator, and maybe the liquidator can go to NCLT to decide this issue. According to my understanding, they have a right of net off. But yes, this is a case that we can actually get it adjudicated, because whenever the income tax department writes you a letter, I think under Section 145, Ankit, is that section right?
245 is the section which allows for adjustments of income tax demands with income tax refunds. And then, of course, there is a recovery mechanism under Section 221, but I'm not sure if that recovery mechanism can be used for interchangeably with income tax refunds.
I think we have now, like we have already done it for 3 hours. So we are actually taking the lesson every day that we should not have such a long session. So in future, we would be coming with the smaller subjects rather than the bigger subjects. So the only thing that we have developed in ourselves is that whenever we take up a subject, we would try to cover it to the maximum possible sizes. Maximum possible coverage. So that is the reason it is taking time. That I was trying to speak a little faster today, but still we had to force close some of the items. I feel like taking up
topics. Yes, smaller topics, I think, is the future, because that will also that can be specific and that can also be, I would say, it can bring more attention from participants. 2.5 hours, 3 hours is a long time. So I
Yes.
think we can. I would like to thank all the participants, and we had a huge number today, and we still have 250, 300 participants after 3 hours. So thank you, everyone. Um,
So thank you very much, participants, and I feel very happy when so many people remain connected with me for 3 hours. And I thank my co-panelist, CA Ankit Goel and CA Anil Agarwal. Uh, the uh, Again, I would say that I like to handle more and more questions, because in case any question is there which I'm not able to answer, and then I'll go home and work on that question, and that's enriching my own experience and knowledge. So I'm doing these webinars only for my own learning. So this is my way of learning. Thank you very much. I will remain connected with you, and please look forward to uh, my coming webinar, which will be on the transactional audit versus forensic audit, because there is a huge confusion in the market. What is the difference between transactional audit and forensic audit? So I am preparing that subject in detail, and please look forward to that, and please do join. And that would be a very, very detailed analysis of what a forensic audit is as per the RBI guidelines, and what a transaction audit is as per IBC, and what are the transactions under section 43, 45, 50, and 66, and what are the remedies available. And that also would have many live examples of transactions which can be covered under section 43, 45, 50, and 66. With all this, thank you very much. And I wish that you still stay safe from the coronavirus. As much as you can work from home, you should continue to work from home. And digitally performing from home is very, very easy nowadays. It is possible to work. Even as a chartered accountant, I have tried even the ledger scrutiny while sitting at home, and the other screen is with the client. So even the ledger scrutiny can be done on any software, including Tally software, that can be done while you are sitting at home. So you are not meeting anyone, and the accountant of the client is sitting at his home, and the client himself is sitting at his home. So still the ledger scrutinies are being done for the purpose of audits. So don't use this COVID as a reason for keeping the things pending. You can still finish, and you can still showcase this time to the society, to the government, that yes, the professionals can adopt digital methods of doing the things, and the offices are no more important. It can be done through digital technology. Thank you very much, and goodbye to all.
Thank you.